All right. Hello, everybody. Welcome back to another episode of the Market Close. It is Friday, December 12th, and we are ending out the second week of December. Ugly day. Ugly day. I mean, it was clearing up a little bit before we left. It is still kind of clearing up a little bit, but some of these individual stocks have been getting hit. S&P 500 here, right here, down about 1.12%. I think the worst of it was 1.15. And you've got the slightest of slightest bounces, but nonetheless, still a pretty nasty day. Nvidia right there, 175. That's down 3% on the day. Palantir is down 2% on the day. Hoodie is down 3.2% on the day. All of these are up a little bit from their absolute lows, but nonetheless, they are still down. Broadcom, absolutely disgusting. It got to 355. It's at 357. We'll talk more about Broadcom, but that's down 12% on the day. That was the first domino to fall, which ended up cascading into a variety of their AI headlines that ended up it's not being pretty for the markets. But Broadcom got the brunt of it today. Netflix holding onto its green. Bitmine's down 8% because Bitcoin and Ethereum are down. Bloom Energy's down. Iran is down. Amazon is down. All of these names, anything that is in the risk on part of the market. Bitcoin at least holding above 90. It did get to 89.5. Is down. So what happened today? What happened today? Well, I think at around 11 a.m. Eastern this morning, there was a headline that came out that OpenAI would be delaying a data center build out with Oracle. And well, that made the market a bit upset because the idea is that OpenAI can't pay for any of these data centers. A lot of this money is fake. This $300 billion of remaining performance obligations from Oracle never really existed in the context of OpenAI's potential deal with them. And so the market's upset about this idea that we're never going to be able to get this type of money. And so we shouldn't be giving Oracle this type of a premium that bleeds into all the other AI names. Oracle comes out an hour later and says three things. Number one, site selection and delivery timelines for OpenAI data centers were set jointly with OpenAI. There's no delays to any sites, and all milestones are still on track. Now, this was somewhat appeasing to the market. The market started to recover a little bit when this news came out. The problem is it doesn't necessarily make the argument that we're going to immediately begin the performance obligations from this OpenAI contract in 2026. And I think that's the issue right here. So you notice how they word site selection and delivery timelines for OpenAI data centers were set jointly with OpenAI. Basically, they're saying, hey, if you guys think there's a delay, then yeah, maybe you can interpret it as a delay, but OpenAI and us always had, for example, 2027 in mind, not 2026. So they're kind of saying like, yeah, it is a delay in the perception of what you guys thought it was going to be, but we never said it was going to be 2026. At least I don't think Oracle ever said that. And so we always thought it was going to be 2027, which means now that the news is coming out that it's not going to be 2026, it's going to be 2027. You guys want to freak out. That's not our problem. That's your problem. I think that's essentially how Oracle framed this argument. And when they say there were no delays in place, they're basically saying we never thought it was going to start that early. And if you guys thought it was going to start that early, again, that's not something that we can be concerned about. Oracle right here, their credit default swaps got to a 4-month high today. They're up 200% in the past 4 months. That stock's still down 4.72% on the day. Same thing with Broadcom. So you had Broadcom that kicked it off down 12%. The reason Broadcom was down, unfortunately, they also said that their exclusive 10 gigawatt ASIC data center agreement with OpenAI is not going to start in 2026. Market wasn't upset about that, or market was pretty upset about that last night, ended up being more upset about that this morning. And then you have another piece of OpenAI news with Oracle. Your 1-2 shot, that'll give you a red day, and that's obviously affecting the rest of the stock market. Nvidia being a big name that's going to get hit because it's center in the AI trade, as that's down 3% on the day. S&P 500 down 1.13%. The crazy thing about this, Tesla actually holding green. So Tesla was at 463, came all the way down to 445. Now it's back to 457. So Tesla, which tends to be the most high beta Mag 7, actually holding on to this momentum in the midst of some of this AI collapse. But the ironic thing about this is that we were at all-time highs yesterday after hours. And so I think the whipsaw of emotions and price trajectory and essentially price action that we've been used to over the past couple of weeks, that is continuing. We got a little bit of reprieve over the past week and a half as we got back from Thanksgiving, where it wouldn't be that big of a deal, or we thought it might not be that big of a deal, and it came right back. BM&R down 9% on the day as well. I think the takeaway here, and we'll talk more about some of this stuff as we get through the show, but the takeaway is the market is fragile, and the market fundamentally gets scared every time there is a hiccup on the AI narrative. And today we had two hiccups. There's no ifs, ands, or buts about it. We had two hiccups with this Oracle headline. Whether the headline is reasonable or not, if it changes the entire thesis or not, which I don't think it does, but they were some hiccups. And that's why the market got upset. And I think that's why we're seeing some of this pain. Okay, Trump is live right now as well. We're getting some quotes from him. Let's pull up some of these quotes right here. Trump says, I'm leaning towards Warsh or Hassett to lead the Fed. Trump says next Fed chair should consult with him on interest rates. Trump says interest rates should be 1% or lower a year from now. I don't know if we're going to get 1% rates next year, but there you go. So Trump is narrowing the search down to Hassett or Warsh, which is kind of what we all thought. But Hassett or Warsh, I still think it's going to be Hassett. The street might like Warsh more, but Hassett might end up being the one who wins. 1% rates, that's what Trump is saying right here. And yes, Trump asked where he wants interest rates to be a year from now. Trump said 1%, maybe lower than that. I mean, obviously, Trump's going to say whatever he wants to say, but I don't know if we're actually going to get 1% rates or lower. If we are, I mean, maybe this market is going a lot higher, and if that results in a crazy bubble, it is what it is. But if rates are going lower, you might have some money continue to be put into the risk on area of the market. By the way, speaking of money that needs to be allocated, money market funds, we didn't get to check it yesterday because we had Broadcom earnings, kind of a nothing burger, 1.19 billion. 1.19 billion. I'm buying so many houses if I have 1% rates. Yeah, hopefully that gets mortgage rates down to at least 3 or 4%, if not lower. But then again, it's going to be hard to see if that actually plays out. 1.19 billion into money market funds that came in over the past week. Last week it was 85 billion. So again, nothing too crazy, but that is what we got. All right, let's hear from Aswath and see his perspective. He's the Dean of Valuations at NYU. This is his current thoughts on the state of the AI trade and where the market is going.
Plausible. And I think that's at the basis for why there's so much disagreement. It depends on how plausible you see that pathway is. To give you an example, take Nvidia at a $5 trillion market cap. If they can maintain their existing nosebleed margins, 53% net margins, return on equity in the triple digits, they can get there with 600 billion in revenue, which is not a big deal. I mean, they're at 170 billion already. With 20% growth, you can get there. So the people who are upbeat about Nvidia are seeing a plausible pathway there if they can do that. The question is that probable? And that's where the disagreement comes in. And I think that's why it's got to be personal. It's not something that you can hear from other people. You got to look at the numbers and say, I can live with this. I can make this assumption and be okay with it. And every one of these companies, I think, has a plausible pathway to get to the market cap they're at. And, as long as that's there, you're going to get disagreement about these stocks.
I think what's really provocative from you today in terms of your notes to our producers is that you put forth that this is not the bifurcated market that some would paint it to be, that the remaining 493 are also trading, in your mind, hefty multiples of earnings. Explain.
Mm-hmm. I mean, you take the 7 out of the S&P 500, look at the rest of the market, it's trading at 22 to 23 times earnings. And you could argue that the remaining 493 companies have much less rosy operating metrics than the Mag 7. They don't have the kinds of margins and the growth that the Mag 7 have. So when people talk about this being a bifurcated market, they act like the Mag 7 is essentially they're the only ones that are overvalued. The rest of the market somehow is fairly valued. I don't think that's true. This is a richly priced market across the board. And if you fact the differences in margins and growth, I'm not sure the remaining 493 are bargains relative to the Mag 7. They look pretty richly priced to me as well.
What looks undervalued to you, if anything? Presumably you've thought about that.
That's why I said coming to a conclusion that the Mag 7 are overvalued, the rest are undervalued, is going to be tough to do because everything's been pushed up. It's like a rising tide. And with the Mag 7, you have this added oomph of a high growth plus high margins at scale. I mean, that's the amazing part. Is they're growing when there are 150 billion, 200 billion, $250 billion revenue companies. That's, I think, almost unprecedented. And the market is factoring that in, rewarding these companies. Whether they can keep doing that becomes the area of disagreement because I think that things only get rockier and more difficult from this point on. You saw that when Google announced that these new chips that compete with Nvidia chips, you saw the sharp sell-off in Nvidia. I think you're going to get more shocks like that to the system, and the question whether the story can hold up.
Huh. Well, what does your own portfolio look like these days? You've never really been shy in sharing the moves that you make. Could you do it again?
I'm down to 5 of the Max 7. They're there because they've been there, and they're not overvalued enough that I want to dump them. I did, sell off the rest of my Nvidia shares just recently, and I think that was the last segment of Nvidia. And if it continues to go up, all the more power to the people who continue to hold Nvidia. But for me, I think I've gained enough from its rise that it'd be greedy for me to hang in there and say, give me more.
But do you agree with those who say that 2026 is going to continue to see more dispersion among the mega cap stocks, among the Mag 7s, that they're just not all going to trade like the monolith that they once did?
And they haven't for about a year, right? Even if you look at this year, the Mag 7 have moved in different directions. This is not 2022 or 2023. But if you could tell me what one of the Mag 7 stocks did during a week, I could tell you what the other 6 did. Now, if you tell me what Bitcoin did today, I can tell you what Nvidia did. I think you have a better shot of predicting how these stocks will do by looking outside of the Mag 7.
So the perspective continues to be by Aswath that everything is overvalued. And, he's been holding some of these Mag 7 names for a long time, which is why I guess he's not selling some of the other ones. He is out of Nvidia. He does not believe this one is worth holding on to. And the S&P 400, wow, Oklo down 14%. I didn't even see that. Ondas down 2, Roblox down 6. Everything is really hard to find some safety. I mean, maybe Netflix was safe. Verizon, Tesla ended up being safe today. Lulu ended up being safe, but everything else getting hit. His argument is the S&P 493 are also overvalued. And there's not a decent level of excitement there. Now, we're going to listen to some other clips throughout the rest of the show, but I don't know if you guys have had a chance to listen to the new Tom Lee podcast on Scott Galloway's thing. I think I played like a 1-minute clip of it in the morning. I listened to the whole thing throughout, since I left the market open. Guys, he's not the most bullish, and we'll analyze it. But if you listen to Tom and you really listen to what he's saying, he's not bullish. He has this $7,700 target, but even the way he was answering questions about bubbles, concerns around AI, the way he's talking about the labor market, I mean, you guys can judge for yourself when you listen to it, but it's not the same bullish Tom Lee from a month ago. I mean, fundamentally, I felt there was something different. And in many respects, he was agreeing with a lot of the arguments that the podcasters were asking him about, and that came from a much more bearish perspective. So, I mean, he has a target, but he's calling for a 20% drawdown on the S&P before we get anywhere near 7,700. And so I just thought it was interesting to listen to how he's kind of framing it, and we'll kind of go through it together. But nonetheless, you are seeing some more people start to ask deeper questions. And unfortunately, on a day where Oracle ends up giving you this OpenAI news, it compounds and results in a pretty negative day. And unfortunately, that's what we're kind of seeing on the day. So we got the close in about 10 seconds. We'll talk more about it. We'll talk about some of this Japan stuff coming up next week as well. We have a couple other macro headlines. We're getting these Wall Street Journal quotes from Trump now about the Fed. And so we'll go deeper into that and analyze what that looks like as we get into the close. All right, Friday, December 12th, 4 p.m. Thank you, everybody, for being here. The stock market is now closed, and we have ended out the second week of December. All right, the bleeding stopped. Yes, hopefully after hours gets the bleeding to take a little bit of a pause, but nonetheless, ugly day. No way else to kind of frame it other than it was ugly. Nvidia right there, 175, down about 3.2%. Nvidia now $4.25 trillion market cap, down from about 4.7 earlier in the week. S&P 500 right there, 681. That was down about 1% on the day. EOSE, that was down 9%. Oklo down 15%. Every energy name got hit based on the idea that Oracle and OpenAI were delaying these data centers. And as a result of delaying these data centers, the energy names are feeling some of the pain because the energy names were going to catch a bid because of the data centers. I mean, I think that's the reason. Maybe there was something else. Obviously, a lot of these names are high beta, but that's why I think you're seeing a lot. I mean, even ENS, which we talked about ENS on Equity Edge like 3 weeks ago. This stock does not have a massive multiple. Even this one was down on the day, $5 billion market cap, given it's in the energy ecosystem. Robinhood down 3% on the day. Palantir down 2.1%. Palantir still holding 180. It was down to 179 at one point. So you did get a little bit of a rebound, but that is down from about 187 early in the morning. Apple, a little bit of safety today, 278. That is green. Oscar was up about 5%. There is now a 30% chance on prediction markets that we're going to get a shutdown. It was like 10% last week. So something happened throughout the day to get the prediction markets to think that we will get a much higher probability of a shutdown, which again is not the best news going into January. So we'll see any implications from that. UNH, that's up about 1.4%. Grab did hold around 520 throughout the day, ended up falling 3 cents as we got to the end of the day, 515. So that's down about 0.5%, but it was holding 520 for the majority of the day. The weed stocks still ended up doing well. Aurora Cannabis up 18% on the day. We did not get an executive order with the scheduling of marijuana as a Schedule 3 drug. So that hasn't happened yet, but that still is getting the market to be excited. Planet Labs right there, that's up 4.38%. And then where is Rocket Lab? Rocket Lab is holding 61, up a good percentage for the week. Can't be too upset about it. Down from 65, so down 3% of the day, but still holding 60, which is not too bad. Disney, we had that big announcement with OpenAI. That one's basically flat on the day. Verizon was flat on the day. And then Tesla, which I still don't know why Tesla pumped. I think the executive order on the federal mandate for AI standards probably is going to make FSD more regulated and not have to go state to state to be able to get through unsupervised FSD. And maybe that's the reason for the pump. But outside of that, not sure why Tesla got a bid, but it was one of the only Mag 7 today that got a bid. Amazon as well ended down on the day 2.3%, 226 on Amazon as we are ending out this market for the close. Amcor was down as well. I mean, Amcor is a big supplier with Amcor down 6% with Broadcom. So unfortunately, Broadcom 11.43%. Broadcom lost about 40 billion in market cap. A lot of derivative plays. Where did Google end? Google 309. Okay, it was 308 in the morning, 305 at the bottom, 309 it jumped to. That one's still down 1% as well. That's what we got. That's what we got on the day. Let me know if you bought the dip, if you took advantage of any of these stocks. I bought a couple of these names in the morning. Not massive amounts, but just a nibble on some of my kind of core positions that I care about. Outside of that, and again, we'll go deeper and talk into it, but I don't know. Today's price action was weird. You had a lot of different perspectives come through, and some of those perspectives argued that this Oracle stuff is stupid. Other perspectives came through and said, well, this is going to be the beginning of something bigger in regards to the delay of data center construction, which theoretically could hurt a lot of these other names. And, you know, we know that there's a bottleneck when it comes to power for data centers, so I don't think that's surprising. But the deeper concern is like the way the market priced a lot of AI stocks today was that there's no demand for data centers. It wasn't even like, oh, there's a logistical concern about how to set up the data center. It's like, oh, no, there's no demand, which is not the case, or at least that's not the evidence that we were presented today. But yeah, as Happy Melly says right there, the market is very conflicted right now, incredibly conflicted, and that's why I think we're seeing some of the pain. I see some Nvidia, I see VG, I see Next, I see a little bit of Netflix, I see some Hood, I see SoFi, VRT. I see Broadcom. A lot of people were waiting for 360, 355. I mean, you got close to 355 this morning. VRT, look at that, down 9% of the day. Another data center play in liquid cooling. I see a bunch of Nebiuses. Iren, did that close below 40? That's, yeah. Well, no, not below 40, but just above it. Still down 8% on the day. Rubrik, like, why was Rubrik down? Like, did the data center thing have anything to do with Rubrik? They had a great earnings. So I do think a lot of these names unnecessarily took a hit, but they did indeed take a hit. Bitcoin right there, 90,000.3, as that was down about 2% on the day. And then do you think Tesla's good for covered calls here? To be honest, I don't know why Tesla moved today. If anyone has a reason, let me know in the chat. So yeah, I would still be conservative, but Tesla breaking out to 500 by end of year, or even that 480, 490 might be a little tough if the S&P is not helping it get there. going against the S&P today was nice to see. But then again, Tesla does this all the time, and then it tanks the next week. Like, it's just one of those names that has a lot of momentum up or down. But that's what makes the premiums amazing. So yeah, I wouldn't get super aggressive and do like a 460 call, but like 475, I don't think it's too crazy going through by the end of the month. Rivian was up 20% on the day. Rivian ended up only down up 12%. Still a great day for Rivian. Let's look at the heat map today. Rivian, Lulu, couple of these defensives ended up holding on throughout the day. This was what tech looked like. It was red. Microsoft, Oracle, Palantir, Broadcom, Nvidia, AMD, Micron, both were down 5% on the day. Financials held strong. Healthcare held strong. Google and Meta got hit. Netflix held strong. Amazon got hit. Again, Tesla was one of the only tech stocks that was actually green, along with Adobe. Adobe got some love today. That was up 2%. And then Walmart, Costco, consumer defensives ended up holding a little bit of green. Did Tesla move on the Rivian news? I don't think so. I mean, maybe. A little weird if that would be the case. Yeah, the market goes like, OMG, Rivian chip's going to replace Nvidia in data centers, right? Like, that's how it almost felt Rivian moved today based on the chip announcement. But yeah, I don't think Tesla necessarily followed that. Okay, let's pull up this Tom Lee argument on the podcast today. I mean, I do think maybe it's just me, and he still is bullish, but I do think there is a different context of how he presented his argument, and I'll let you guys be the jury of this. So let's play this for a couple minutes and we'll get some perspectives. But there is the point of what he's saying in this podcast, at least that's what I got from it, is expect a downturn of 20% next year. Like, be ready for that. That will happen. It's almost like he's speaking that it's inevitable because we're getting frothy, essentially, is what I got from his argument. And then you'll get a recovery to 7,700, which means we would have to recover, much more than 20%. But that's kind of the broader argument that I got from this podcast.
And do you think those would be the trigger of such a correction?
Let's start with the one that you just mentioned. The stock market, we're up 16%. So I think if we rally 3 percentage points, we'll be 3 years of 20% gains back to back. And it's actually
a couple of you guys in the comments saying, I picked up on how you're feeling. Okay, so I'm happy. The rest of you guys will hear right now, but I'm happy it's not just me. There's a couple of you that listen to the podcast already, and you're saying you picked up on that same feeling. I think it's kind of evident the way that he's describing kind of what he thinks could play out for 2026.
More common than we realize. In fact, when we look at the last 65 years, it's happened in 20 times in different countries, and multiple times in the US. 12 times. It means a lot of good news is priced in. I mean, of course, stocks being up 20% a year, 3 years in a row, it's definitely pricing in a lot of good news. So to me, I do think that we have to consolidate those gains. And that's why I think a drawdown next year makes perfect sense to me. But because there isn't a lot of leverage in the economy, household sector has not really borrowed money. It's been expensive to borrow money. And even margin debt, it's risen, but it hasn't risen parabolically. So it's actually essentially tracked S&P gains. So it's not like people are borrowing faster than the market's been going up, especially if you look at a 5-year CAGR. So I would be in the camp that as long as the economy's holding up, that drawdown is going to be viewed as a buying opportunity. Now on AI valuations, it makes perfect sense for someone to say a lot of the valuations for AI are probably absurd because this is the nature of a exponential sector, right? If we look at an industry that could grow parabolically for 10 years, all of the future value is in the latter half of those years, right? So and then we're trying to discount that back to today. And so stocks are going to look absurdly expensive. And more importantly, investors make a common mistake, which is that they assume that the existing universe of companies are going to be the central cast characters over the next 10 years, which is not the case. So the reason valuations don't make sense today is that, one, of all the AI stocks, I'd say it's probably safe to say only 10% are going to be good investments. Maybe it's even generous, maybe 5%.
I mean, when's the last time you heard that from Tom Lee? By the way, Derek, thank you for being here. Thank you for the gifted 50. 50 of you guys just got gifted memberships courtesy of Mr. Derek Wall. So thank you, Mr. Wall, for those gifted 50. But I mean, again, when's the last time you heard Tom Lee say that? Only 10% of the AI companies today are going to be good investments. That's being generous, maybe 5%. And again, that's a totally reasonable opinion. And I think that's actually, one could argue, a logical opinion. There's a lot of these AI stocks that are just like stupid. But you never heard it from Tom in that much of an explicit way. And as you go through the podcast, you start to recognize a little bit more cause for concern that he's putting out there. But he's also kind of saving himself, right? Because he's like, oh, 20% drawdown, but then we recover to 7,700. It's like, I love you, Tom, but you're playing both sides here, right? I mean, last time we had a 30% drawdown. The only reason we recovered in 5 months is because Trump immediately pivoted the whole tariff stuff. I mean, if it's not like a light switch type of buy the dip opportunity like it was in April, which was, that doesn't happen that often, to go down 20% and then recover 40%. I mean, it begs the question, like, how likely of a scenario do you think that is? I'd rather believe in a situation where we don't have a massive drawdown, but we also don't have a massive upside case. So maybe the S&P is 5% next year on that perspective. But to go down 20, then go up 40, I don't know how plausible that is to believe as well.
And of course, there's going to be a new emergence set of new players. And in fact, the economic model might change. But it doesn't mean it's a bad investment. And we've highlighted this as generational trades in past reports. For instance, like if you look at the internet, if you bought the internet basket in 99, okay? So you bought it near the peak and you held it to today, you actually still outperformed the S&P 500, even though 99% of the stocks went to zero. So it was a bad investment if you tried to pick a winner, but it wasn't so bad if you held it as a basket. So I think AI, it's probably going to be fair to say 90% of the stocks are going to do way worse than people expected. They were too optimistic. But I think as a basket, it's probably going to outperform.
That all makes sense to me. I'm with you. But it seems to be a little bit more nerve-wracking when we realize that a lot of the AI companies are the largest companies in the world. It's the big tech companies. I mean, I think Google is an AI company at this point, or an AI stock, Meta, Nvidia. I mean, these are the largest, most valuable companies in the world. And the market really depends on their performance. So when I think about the idea that many of these companies and the expectations that have been pinned to the AI cycle, the fact that could affect some of the largest, most valuable companies in the world, where we're seeing the highest concentrations in those small companies, the higher concentration than we've ever seen in history, to me, that makes it scarier, what you just said. So I guess my question is, do those companies, do the big tech companies, the Magnificent Seven, do they count in your analysis of AI valuations being too high and the possibility that perhaps we might lose out, or that the value won't actually show up for many of these companies?
I might even just add to your concern, because there's
Again, I might even just add to your concern. Like, I'm just presenting what I heard an hour ago. I mean, you got Tom Lee saying, yeah, you're right. And here's another reason to be concerned. I'm just saying, it's obviously we're trying to crowdsource perspectives and understand this stuff, but this was not the type of bullish sentiment you've been hearing from him throughout the entire year.
Because there's a lot of CapEx here too. So that these are, a lot of the Mag 7 used to be asset light businesses. The remarkable equity, rent-seeking model of them was that they could create growth with very little spending. I mean, R&D spending was there, but really CapEx was not there. But today, as you know, AI is extremely capital intensive and it's energy intensive. And it's only justifiable if it's replacing real work somewhere else. Then you can justify, because now it's creating assets to replace future OpEx, I'm going to give you a spin about what's happening that is not disagreeing with what you're saying, but it's probably observing a change in the reality, okay? Which is tech companies are becoming a bigger part of our life. So naturally, they're going to have a larger share of spending. By the way, we wrote about that in 2018, that if you go back to 1930 and you just use simple demography, okay, population tables, whenever the population growth rate grows faster than the prime age workforce, which means you have compounded labor deficit, you've always had a technology cycle. That is 1948 to 67 and 1991 to 99. In both of those periods, the population growth rate was growing fast, which is demand, faster than worker supply. And we entered the third epoch or era of labor shortage, which started in 2018 and it's going to last to 2035. So then technology spend is necessity because you don't have as much labor available, so there's going to be less wage spend.
Yep.
Now, if I substituted the word and called this, instead of the word banks, tech companies, I called them financial institutions, we would not be saying there's a financial institution bubble, because for every unit of GDP growth, there's a unit of financial spend. I mean, it's literally the other part of the ledger. And in fact, the financial industry has all circular spending. I mean, think about this. Real estate is valued as a separate asset, but every company needs real estate just to run a business. So why are we valuing real estate? Like in a GDP sense, real estate should be an interim product, not a final product. So I think tech is becoming so central to the economy, especially because of labor shortage, that when we see tech intensity growing, people are flagging that as a bubble, whereas I'm actually just pointing out it's actually out of economic necessity. But it becomes a bubble if the multiple we're applying to the tech streams don't justify higher valuation. I think tech earnings are probably more valuable than Costco, for instance.
Yeah, agreed.
Or Walmart, right? But Walmart trades at 37 times forward earnings and Costco trades at 50 times. So Nvidia trading at 27. I mean, is there a bubble in Costco and Walmart because Nvidia is at 27 times earnings?
100%. And we've looked at that.
So you can listen to the podcast yourself. And as you can see right there, he's still making the argument right there. I'll put the link to the podcast in the chat that obviously we are not necessarily seeing the bubblicious behavior that the street is expecting or even perceiving because of, for example, Costco and Walmart not being the most important financial institutions or companies in the country. Very important countries, but one could argue that the tech companies are probably more important. But a company like Nvidia, which is at the center of the AI trade, is not trading at a euphoric multiple, given it's trading at 25 times next year's earnings. So, I mean, look, it's kind of the takeaway I got from that is a hedge to both sides. There is an analysis on why, for the first time ever, I've heard Tom say 90% of the AI stocks are going to zero, which, look, there's a lot of stupid, crappy, dumb names that just put AI in the ticker and they say like they're an AI company. They're not even growing. Like, yeah, those are probably not going to be some of the best companies in the world. But it's the first time you heard Tom say 90% of the AI bucket of stocks. I mean, he's essentially comparing it to the internet stocks, which 90% of those went to zero. And we got Amazon and Google from it, why it ended up outperforming the S&P, because those companies were just so transformational. And I'm assuming the most important transformational AI companies will probably outperform the S&P over the next 10 years. But you are seeing the first resemblance of him making that claim that like a lot of these companies probably are invaluable. And then sort of the second argument he's making right here is that this idea of consolidating the gains after a 3-year bull market, which is entirely reasonable. And I don't even think there's like a problem in this argument, in this chain of thinking from a like logic perspective, that if you have 3 years back to back of 20%, let's say we end this year at 15, 16%, whatever it is, those are a massive 3 years. We have to consolidate. The problem is his argument, and this is the part where he's losing me here, is that let's just say S&P ends the year at 690. Okay, 690 losing 20% would put us back at 552. Okay, 500, 52 on the S&P. So then to get to 770, we would have to go up, 39%, 39.4%, 40% to get to his level of 770, 7,700. So his outlook, and again, we're going to get a lot more outlooks from a lot of these other banks. Not all of them agree with him, but Tom Lee is saying we're going to go down from 690 essentially to 550. And then somehow, some way, we're going to rocket ship back up to 7,700. Yeah, it would be a repeat of 2025. The difference is, I mean, look, I don't know how, I'm probably missing some economic history here, but how many times have we gone 30% and recovered within 2 months? And the reason we went down 30% was because of Liberation Day. The reason we recovered is because Trump said, buy the dip. Like, there was an obvious catalyst to the downside, and then that catalyst immediately reversed to the upside. It was an anomaly. It created one of the best buying opportunities in history. But like, to expect that to happen twice, I don't know. And I don't know why that would even have a chance of happening, right? Like, no one expected the Liberation Day thing to be as insane as it was. No one expected the recovery to be as insane as it was. Do we get something like that happening again? But I don't know. I think it sounds kind of off that we're going to go down 20 and then go up 40. And I think he's trying. And by the way, if we go down 20, I mean, where the hell is Ethereum going? If the S&P is down 20%, what? Ethereum's down 50, 1,500, if that. Bitcoin obviously gets destroyed in that scenario. And if that does happen, obviously that's the time to buy. Like, if we have a 20% drawdown ever on the S&P, that, forget extreme fear, that is the moment you buy. The problem is to try to predict that then we'll go up 40% and recover all those gains and go higher, especially if you have more AI bubble fears that can compound on each other. I just don't know if that narrative makes sense for next year. I think there's other ways you can make a narrative for what happens in 2026. But I'm not going crazy, right? Like, that just sounds a little not believable. And it's the first time, and it's ironic that this podcast dropped on a day where this whole Oracle OpenAI stuff came through. But it is a bit ironic that this is kind of his frame of analysis right here. And then, you're getting these concerns about data centers. So look, I think we have to obviously do a lot more work and in terms of analyze what's going on. This Tom Lee is just one person. I'm going to try to get a lot more opinions on seeing some of what these other companies are saying. I want to know what the consensus S&P target is for next year. Because I think the highest I've seen is 8,100. I think Evercore said 9,000 in like their Super Bowl case. And then, I guess the lowest I've seen so far is like 5,700, 6,000, but we haven't had a consensus view. The consensus going into 2026, by the way, or 2025, was 6,750, which we're probably going to close above if we, hold these levels and don't fall another 2 or 3%, because we're at 681. But the analysts kind of got it right going into 2025, because I mean, we're relatively at that same level unless we get back up to 7,000. So yeah, I think these are two things that we definitely need to think about. Would the Supreme Court tariff ruling be the reason for the drawdown? I actually think that would be the reason for the upswing, because the market doesn't like tariffs. The Fed definitely doesn't like tariffs. Inflation potentially might not be that big of an issue, although there's two pushbacks to that. Number one, the administration came out yesterday. I think Besant said that they've got, or it was either Besant or Hassett, said they have plans to deal with the Supreme Court if they do overturn the tariff stuff. So they're going to try to institute the tariffs in a different way. And then the other argument here is that, I mean, to the drawdown point, it's like if the market has uncertainty around tariffs, that's not a good thing. Even if Trump is able to finagle his way into still implementing the tariffs, which would also create more uncertainty, because then it would probably be questioned from a legal perspective. So yeah, could it result in a drawdown? 100%. Could it also result in an upswing, and then maybe later the market, because they're just so scared about what's exactly going to happen, that results in a bit of a drawdown? Yes. But again, no one knows. I think that's why it creates a lot more uncertainty. Let's listen to his perspective on the labor market, because that is also a pretty important issue right here. And this is what he had to say about where labor will go. One of the other bear cases for most people is that if we have this AI boom, but people lose their jobs, that's not necessarily going to be the healthiest for the economy.
We're in this labor shortage cycle from 2018 that will last through 2035. And you can't avoid the catastrophizing around the destruction in the labor force from AI. Do you still believe we're going to be in a cycle of labor shortage even with AI?
I vacillate because there's times where like when I read a book like The Coming Wave, I panic and I realize like, wow, like we need to re-educate society. But one thing that gives me hope is that we did at Fundstrat study another technological wave that wiped out at least 20% of the labor force in the 20th century, which was frozen foods. So what many people don't realize is that when Charles Birdseye created Flash Frozen, which, by the way, was a venture backed by Goldman Sachs. It was a VC backed company.
I love this.
And by the way, his name is Birdseye because he was an ornithologist. He actually was studying birds. But he found that the Inuit tribe in Alaska had kept their fish super fresh, and it's because they were putting it in a frozen saltwater solution that flash froze the fish. If we look at the labor tables from the 20s, 40% of the US labor force was employed on farms. It was literally, we spent, most of the economy was people working on farms, and most of the service sector that was defined back then were household servants, people working for someone else. Food was over 25% of the wallet prior to frozen foods being widely, mass market, because most food spoiled on the way to the supply chain. And so grocery aisles were mostly fresh. And what was frozen back then had freezer burn. It was terrible. So flash frozen allowed suddenly the cost of food to drop dramatically because you had less spoilage. And the number of people working on a farm today is down to 2% of the US workforce. So flash frozen was really the key innovation that brought down the cost of food from 20% of the wallet to 5 or 6% today, and reducing farming labor from more than, I think it was 40% at the peak, down to 2%. An economist in 1920, okay, let's just pretend on CNBC in 1920, there is none, but let's say there was a CNBC in 1920, and these economists were saying, frozen food, if it comes along and it's going to wipe out 95% of all farmers, this is going to wipe out the U.S. economy. The U.S. economy can't survive frozen food. And instead, it freed up time, right? And it allowed people to be repurposed, and it created a completely new labor force. So Scott, to your point, I think that there is an adverse outcome, but then when I look at past episodes of huge labor disruption, it's actually had positive outcomes.
Okay, that was a lot of detail and storytelling to make the argument that AI will open up new opportunities and jobs. But as you can tell from this pod, I mean, I really don't think it's just me. You're getting a glimpse of him making a little bit of just a sort of pivot in terms of his perception of how he's thinking about the labor market, how he's thinking about AI. Obviously, a lot of data backs his research, which is fair, but it starts to get very confusing when you make the argument that 90% of the stocks are overvalued, 20% drawdown, 40% upside after that drawdown, and that's how the story plays out. Like, it feels like Tom is confused. And that's okay. He's a human being. He's allowed to be confused, but nonetheless, it does feel like he's a bit confused here. Let's bring someone onto the show that they've not been that confused about the story around semiconductor stocks. Let's see if Broadcom or Oracle ended up potentially making him a bit more confused today. Ladies and gentlemen, Jose, what's up?
What's going on, brother? How's everything?
Everything's good. We had a little bit of a crappy day today, and I think you can definitely help us give some analysis on what's going on. I think we'll start off with Oracle before we get to Broadcom. We didn't talk since the earnings. Neil and I streamed this one together, which, by the way, I kept calling him Jose. I don't know if did you see that? I kept saying Jose, and I didn't notice. And he would just look at me, and I'd be like, "Why aren't you answering?" And I'd be like, "Oh shit, I just called you Jose." So, yeah, he's European Jose now. But
it's because you wish I was there.
Yeah.
Unfortunately, I was not. Unfortunately, but I had to take the little one to a few things that day.
What was your perspective on Oracle earnings? And with that, any thoughts on this Oracle OpenAI data center delay that we got today?
I mean, I thought Oracle earnings was a great insight of the AI market. I mean, they mentioned that this quarter alone, they grew RPO by I forget the actual number, but it was north of 60 billion just in one quarter. And it wasn't just on OpenAI, right? I think that's one thing that they wanted to do was kind of escape the OpenAI bear thesis that was once a bull thesis, now it's like a bear thesis. It's funny how the market reacts. But they mentioned that this RPO was mainly because of Nvidia, Meta, and other names. So they at least try to diversify. And then within that RPO, it doesn't have much changes this fiscal year, which ends in 2 quarters, but it did add an extra $4 billion to next fiscal year in their OCI. And $4 billion, I think last time they projected around 34 billion. So 4 billion is about a 15% growth on guidance just on OCI, which I thought is impressive, right? Just in a matter of a quarter. Because of that, right, they had to increase capex by 15 billion. Capex, I think, was 50 billion now with the new guide. That's numbers that, like, it's matching to the big boys, right? It's matching not necessarily to it, but it's getting up there, right? I think Meta was like 8, 7. I forget the actual numbers. I know most of them were in the north, but Oracle is getting good. Is getting up there. That I think was very bullish for AI chip companies in general, because it means they're going to spend an extra $15 billion within the next 2 quarters, because they just finished this quarter. So this extra 15 billion is for this fiscal year. So an extra 2 quarters where they're going to spend an extra 15 billion than they expected. So overall for the ecosystem, and I'll throw it back to you just in case you have any questions, but to the overall ecosystem, I thought it was bullish in forms of AI compute demand, and it was bullish for the infrastructure players per se, and then it was bullish for the semiconductor ecosystem because they're going to be spending more money in that AI infrastructure itself.
Do you think then the decline of the stock from 220 to 189 had more to do with the debt that they said they're probably going to be issuing a lot more for this build up?
Yeah, I think so. I mean, I think for them, when you hear this crazy 500, I think sometimes the market just doesn't listen. They have this 523 billion RPO, and most people are expecting it to be this year or next year. They actually gave a perfect picture of it's actually like 16 billion. I forget the actual number, so don't excuse me for not being correct, but it's like something around 16 billion this fiscal year, 34 billion next fiscal year, and then 64, and it continues to grow from there. So I think the market just wants a lot of that RPO to be more front run, but Oracle can't do that. It's all about data center being built up, and they're just building that data center to help the revenue. So I think the market is just hoping for that. And yes, the debt obviously plays a big role. But I think Larry countered back. If I was reading the transcript, and he mentions that there's a lot of analysts that believe Oracle needs to raise over $100 billion to fund this, and they said we don't need 100 billion, nowhere near that to fund to raise to be able to fund it. Obviously they're probably going to raise maybe like 50 to 60, but he believes that a lot of these analysts are thinking they have to raise too much money, and that could be an upside in the future.
Okay, Broadcom, I think the reason they're down today, well, I'm curious, why do you think they're down, and do you think it's because of the lack of OpenAI revenue coming in 2026, which is kind of consistent with Nvidia that says we don't really have a definitive agreement? Why do you think Broadcom took the hit today?
Yeah, to be honest, I actually posted yesterday because I don't know. I feel like Broadcom's becoming a very popular stock. I honestly did not listen to the earnings call just yet, so I haven't have too much information to add there. I wouldn't think OpenAI would be much of a fear. Because they did announce Anthropic is a big customer now with the TPUs and Broadcom and Google. So that's that. Then obviously Google is still doing pretty well. I think now the fear is, I don't know. I don't think I can give you any added value here on Broadcom right now, as I haven't read the earnings. But it's just, I mean, if you just look at that year to date, the stock has done amazing. It could just be as simple as maybe it just ran up too much on excitement, and we're just pulling back a little bit. But I think Broadcom investors are still pretty happy for the year.
I think that's probably the best reason. I mean, this thing was up 80% year to date, and they said a couple things on the call that whenever you get a chance to listen to, not the most exciting, not bearish, but definitely not perfect. And when you're trading at the multiple they were trading at, you got to be perfect. Like Nvidia, They had to be perfect. They were perfect. The market still didn't care. Broadcom wasn't perfect. Obviously, the market's going to care to the downside. So
Yeah, I wonder, right? What is this company worth now? 2 trillion? Is it 2 trillion?
1.7.
1.7. And then you have Nvidia worth at what? 4 point, what is Nvidia at right now? 4.2?
Yeah.
Right. They mentioned a backlog of about 72 billion. They mentioned, right? I think it was 72. And then if you look at Nvidia, they have a backlog of not 500 billion, a little bit less than that, probably still about 400 billion remaining. So I guess just by looking at the backlog, you can say, am I really needing to value this at, should I value this maybe a little bit cheaper than it is right now, just because the RPO multiples aren't the same on those? But yeah, I think overall, I mean, the demand for ASIC is still going to continue to grow. There's a lot of, they have that big customer with Google, and they're doing really well with it. There's actually even rumors that they might have even won some Amazon as well. I don't know if that was confirmed or denied during the earnings call, but the compute is still extremely high. I mean, we've seen so many partnerships with OpenAI and Anthropic just in the past 5 days that show that AI compute is not slowing down. More importantly, Chris became extremely bullish on AI, it seems.
But that's why we freaking fell today. Freaking Chris buying Nvidia. Should have known. Should have known that was no. So what is your general sentiment on AI right now, Jose? Because Nvidia's multiple continues to look ridiculous. Broadcom was expensive, came back to reality a little bit. Oracle probably never deserved to be at 350. It's at 189. That's not crazy. Still 15% year to date. I mean, is there been the neo clouds are obviously getting hit. OpenAI is intimately tied with CoreWeave, which is why I think the headline with Oracle and OpenAI took CoreWeave down. But has anything changed for you? It's kind of just the market's tired of this trade, and that's why we're consolidating.
Yeah, I mean, I think for me, it's a buy the dip moments, right? I think the AI ecosystem, the AI story is still much intact. I understand why the market is scared, right? I mean, I don't think most people follow this market on a daily basis like me and able to have like these diamond hands that I have. And I mean, on the optics look scary. It's like, we don't know where AI is going to go. You hear about delays. Does that delay, is the delay something talking about the financing, which we keep hearing about? Is this financial bubble? Is it about demand? So when you hear just a story like that, it just creates a whole fear of throughout the whole ecosystem. But I think, I mean, for me, I definitely am not worried about anything from demand, from financing, Nvidia's, especially on Nvidia's part. I mean, the customers that are buying from there is not just Oracle, right? It's your Microsoft, it's your Google, it's your Amazon, and all of them are saying the exact same thing about a month ago, that demand is still growing. They still want to continue to grow their market share. Anthropic and Google and OpenAI this week announced various partnerships with enterprise companies. I think OpenAI announced something with Disney, which can be seen like AI slop coming to the overall platform, but more kids are going to be just using AI in general. More parents are going to be using more AI. I do also think that's it creates a domino effect for other creative enterprises to say, look, we can't be left behind. If Disney is doing this with them, why shouldn't we should also go partner up with maybe not OpenAI, but with some AI company, because we need to have that same type of technology. OpenAI also partner up with Anthropic, partner up with Accenture, I think a few days ago. So enterprise are the people that have the big money. They're the ones that have those people on computers 8 hours a day. Compute is going to continue to grow. You saw El Salvador also kind of announced that they're going to be using Grok. More countries. I know El Salvador has been very popular lately, and more countries are going to be like, if El Salvador is doing this, maybe we should also think about doing this, because we can't be left behind. So I think the demand for AI compute continues to grow. So I'm not worried at all about this AI sell-off.
Yeah, well, I agree with that as well. If the demand for AI compute continues to grow, and what we've seen from every earnings, which is undeniable, you can hate the multiple some of these stocks were trading at, like a Broadcom. You cannot deny they had a great quarter. Same thing with Nvidia. Nvidia's multiple a little bit better than Broadcom's. Same thing with Oracle. Maybe their multiple and their debt load not exciting, but they put up a good quarter. So I think that is a fair point, that S&P is up basically 20% this year. Stocks, including the most important companies on the planet, have put up, like all the hyperscalers, all the Max 7 put up very strong earnings. But also it's like, all right, from the Liberation Day lows, forget year to date, a lot of these stocks, I mean, Nvidia is a double from the April lows, at 180, 175. So it's like as much as we think it probably should get a higher multiple if we're assuming that growth rate continues. If it's not, it's also like, all right, it is what it is. I'm curious about your thoughts on this as well. So China's opening up for Nvidia. Nvidia said, we're happy that Trump is allowing us to sell. Some articles came out this morning that said Chinese firms are basically begging the CCP to allow them to buy some Nvidia chips. Do you think this is a tailwind, or do you think this ends up being a nothing burger for them?
I think for Nvidia, it's definitely a tailwind. I mean, Jensen has mentioned in the past that this is a 50 billion opportunity for them per year. And it's not just about the revenue, it's also just about the overall ecosystem. We've heard that a lot of AI developers just actually ends up coming from China. So you want to make sure that your developer ecosystem continues to grow. I think in forms of numbers is a tailwind. In forms of the market, though, it becomes a headwind in the future, because now once it gets approved, and once we start to sell selling over here, we're going to start to see reports. Potentially China, potentially United States is going to cancel this deal. Potentially China's not going to take them, and it's going to create this volatility in the overall market. So I do think it's a tailwind, but I think it's a tailwind that's going to come with a double-edged sword that the media and other players, I don't want to seem like a conspiracy theorist, but it's just, it's headlines get clicks, and scary headlines get the best clicks. So if you ever have, just like with this Oracle thing, you're going to see headlines. That was
going to be my next question. What was your perspective on that when it came
out? On which one? My apologies.
On OpenAI delaying a data center theoretically with Oracle.
Yeah, I mean, and I thought the market was funny, right? If Oracle delayed, well, we saw that it was false, or they dispute the fact. Yeah. But first, I understand why the overall ecosystem fails. Like, again, I think you mentioned it. It's like it either means someone has low demand, someone's not able to finance, and it just trickles down to the rest of the ecosystem. If Oracle, though, in my opinion, the way I see it, if Oracle can't meet the compute because they slowed down on some form of data center, it has to trickle down to someone else. OpenAI, if they really need the compute, they're not going to wait. They're going to say, oh, maybe I have to go buy it from Nebius, from CoreWeave, from Iron, from someone else, from Amazon, right? So I thought the market was pretty funny, because if it's a slowdown for Oracle, that demand needs to go somewhere else, and that's why I found that the whole market kind of going down. Sometimes it's funny. I don't think it's true, and I don't think it's anything with compute. Oracle just had earnings 2 days ago or 3 days ago, and they mentioned that their guidance for OCI for 2027. Fiscal year 2027, which is about 2 quarters ahead of calendar year, is up. Why would they have done that if they expect some form of delays? Why would they kind of create some form of fear if they had some form of delays? But instead, they actually upped their guidance for next year. So, I mean, the data was right there, if in my opinion. And CapEx was still high. Yeah.
Yeah, and they increased their CapEx guidance as well by 15 billion. I think the market's just tired of the AI trade right now, right? Like, and I think you're probably feeling it as well. I think a lot of us are feeling it, that, you know, the market's given a lot of these names a multiple. A name like a Nebius, a CoreWeave is still up a double from IPO. IPO'd at 40, it's basically at 80, right? Nebius is up like 2.2x or something. So yeah, these names are not at all-time highs, but they've definitely made a move. It is now their job to keep executing to prove they deserve their multiple. But do you think the market's just a little tired of the AI trade, and maybe that's where, you know, you get some consolidation towards the end of the year?
I think more fearful than anything is just, hey, we just had this massive drop. A lot of these stocks, I think, right, Nebius dropped from like 120, CoreWeave dropped from like 140s. A lot of these are down probably still 30 or 40%. And it's like during this time frame, everybody scares like, any little noise. It's like they still have PTSD from just a month ago, and it creates that negative sentiment. And I mean, CoreWeave unfortunately didn't do much help to it when they reported earnings. They mentioned that they had some delays on the data center side, but it was more of like just the construction aspect. It had nothing to do with demand, but the market likes to run with it. So unfortunately, I think we need a quarter where like everybody is perfect, where everybody that reports says, look, this is good, to kind of maybe turn that sentiment. But I think I think everybody's tired. I think everybody has that fear of, oh, I dropped 40%. It's going to drop another 20% from here. Let me get off before. Emotions are high on the fearful side for AI investors right now, except for me.
Okay, so my last question for you, and guys, this is Jose's YouTube and Twitter. I'll put in the chat. You can follow him there. Yeah, I guess simple last question. Why don't you have any fear?
Well, I mean, I think mainly it's just because of my workflow. I continue to use more AI on a daily basis. I've even I come from an engineering background, so I do have some tech stuff, but I've created like small apps that I use on my computer now that I wasn't able to do back then, even with like the knowledge that I had. But with AI, I'm able to do this stuff in like minutes. In hours, I'm able to create some crazy things. I talk to friends. One of my friends is actually trying to start a business, and I went over his house a few days ago, and he showed me how like he's incorporating AI so much into this, and it's like it just blows my mind how much AI is growing in real use cases. I sometimes do some form of freelance for various companies, and again, the amount of AI work I see is wild. So to me, it's just real data. From kind of boots in the ground to show me that this AI story is not going anywhere. And then with a lot of these companies, right, some of them might have some crazy valuations, but Nvidia at a forward PE ratio of like what, maybe mid-20s right now, if that. The Amazon, Meta, like they're not that crazy. They've turned a bit around, but valuations aren't scaring me for a lot of these players. And then for my YOLO, not my YOLO plays, but for like my ones that I think are gonna make big money for me, like CoreWeave, like the demand for compute continues to grow, and these are players that are building that massive AI infrastructure. So yeah, it's just I think boots on the ground data.
I think that's fair, and I think anecdotally, a lot of people that are actually using AI every day and sort of seeing the technical aspects of not only model improvement, but how the application of those models are leading to actual productivity gains in their own life. That's a big deal. And then when we get the evidence around, the earnings growth and the data center growth, it's hard to fundamentally deny it as like a fad, as some would say. Okay, actual last question for you, Jose. We're getting towards the end of 2025. So if you had to give me 3 of your top AI convictions for next year, what would those 3 be at this point?
Nvidia for sure, especially at these levels. This one, even though a $4 trillion company, I could see this being a massive player. So Nvidia for sure. Number 2, CoreWeave. I believe CoreWeave is, and it's crazy to think. I always hate when I say CoreWeave because many people think I hate the other players. I don't. I think the whole neo cloud ecosystem is going to do great. I just prefer CoreWeave the most because they have the biggest AI infrastructure out there, about 600 of active power. They're like best buddies with Jensen and Nvidia. So CoreWeave is my second. And I have to stay with the third. For me, the third, I guess I'm going to go with AMD. AMD is that one that's like a $200 billion, I forget the market cap, probably like 350 right now. And if they do reach those earnings per share potential of $20 within the next 2 to 5 years, that's a $1 trillion company easily. So those are my 3 favorite plays. It doesn't mean I hate other semiconductor stocks. And I'm sorry to the viewers if I didn't mention yours. Don't hate me. But in general, I think AI chip companies, I think the neo cloud players are still going to do very, very well in 2026.
All right. I love it. Jose, thank you for joining on this Friday. Have a great weekend. We'll talk to you next week.
Thank you. You too, brother.
Later. All right, folks. That's what we got from Mr. Jose. I do not think Steve is joining today. I think Steve is wrapped up in a lot of different meetings today. So, yeah, we're probably not going to be hearing from him. I don't even think, quite frankly, Steve even saw what happened to the market today. He's been texting me pictures of his lunch all day. So the other thing he texted me about was this freaking OCC news for XRP. Because for some reason he still loves XRP, even though he doesn't buy any more XRP. But yeah, outside of that, I don't think he cared too much about this decline today on Oracle. Again, I think it was a little bit weird because last night, all-time highs on the S&P, then this morning, we're doing okay, and then boom, Broadcom, bottom falls out, OpenAI news comes out with Oracle denies it, market recovers, and the market says, you know what, we actually don't believe it, and you end up just getting a 1% down day on the S&P. Not to mention it's a Friday, so there's tons of options that expired today, and probably had a bunch of different stuff going on with market makers. And that's pretty much what we had. He was on with Tanner. Okay, he was probably on with Tanner then during the middle of the day. He probably, dude, he said like his company like ordered lunch for everybody, but he used it as an excuse to go get his own lunch because they like canceled a bunch of meetings because they all ordered lunch at his office. And he went straight to Patsy's to get his meatballs. I'm not going to call Steve. I already sent him the link. I already texted him. I said, if you're free, you can hop on. If not, it's okay. But he's probably stuck in those meetings that the company canceled during lunch. And now he's there after hours. So if he's free, he'll let me know. If not, then he'll be live tonight. Also, we were live together for 2 hours yesterday. So Tanner called him for like 2 minutes. Okay, that makes sense. Usually Fridays tend to be a little busy for him. Yeah, I mean, Mr. Tarek, no crying at the casino. There is no crying in the casino. Again, I think the thing that really surprised me today had nothing to do with the markets. It was this Tom Lee podcast. It was this freaking Tom Lee podcast, dude. I mean, you guys can listen to it again. This was because look, what's his name? Scott Galloway had Oswald on 2 weeks ago, and he was straight up bearish. He was basically like, sell everything. It's over. Got a lot of people scared. And then we went down, we recovered, hit all-time highs yesterday. Then Tom Lee hops on the same podcast, and he's like, yeah, I think we're going to be okay next year, but we're going to have to go through some real pain before we're okay. And I'm like, okay, what does that mean? 20% down. I'm like, okay, so where's the target? 40% up after 20%. I'm like, so what are you saying? Like, genuinely, what is the argument here? It's just confusing to me because I don't know how realistic it is for the thesis to play. And if we have a 20% drawdown, small caps obliterated, financials obliterated, crypto obliterated. Like all of his picks that he's excited about next year, they're gone if you have a 20% drawdown. Everything's gone if you have a 20%. I mean, Verizon might be okay. But Tom also thinks the Supreme Court decision on tariffs will cause disruption next year. I think he said that yesterday on CNBC. So yes, I mean, that's another, that and the freaking shutdown, those two coming together could be an issue. And then unfortunately, those poly market odds about the shutdown. By the way, Trump is not live right now. I think he might be live later, but he's not live right now. The shutdown odds, they increased today. And yeah, right now they're at 40%. And that's not going to be good. That's not something that we need to see. The wheat stocks were safe, though. Wheat stocks went higher today. Dude, like we cannot have a shutdown going into, because remember the first shutdown, the one that we had like a month ago, I mean, economists are saying 2% of GDP got wiped out with that. We cannot afford, with the debt we have and the deficit we have, to have another 2% on GDP get hit. Also, we have the jobs data next week, so that's going to be important. Now, the jobs data being, see, here's the issue now. Let's say jobs data is bad. There's no more rate cut catalyst because the rate cut happened. So it's not like bad news is good news anymore. Bad news might just be bad news. Now people might say, oh, well, we'll get another rate cut in January. Maybe that's where the narrative is like, okay, more really bad jobs data means even more rate cuts. Right now, January is pricing in a 25% chance of a rate cut. But it might more so just be bad news is bad news, which is okay. We already know the labor market's bad. So it's like you can't avoid that data being bad. And the Fed probably knows it as well, too, which is why they cut this week. But that could end up being the next catalyst. It just will take a month before we see if we get that rate cut. Yeah, Trump said Kevin Warsh has moved to the top of his list, though Kevin Hassett also remains in contention. I mean, Warsh would be the safe pick because the street loves him. Warsh actually interviewed Alex Karp, if you guys remember. That was back in January of 2022. But Hassett would be loyal. So I think Trump's got to figure out who does he want here. Someone who he knows is going to cut rates, or someone who he knows is dovish enough to cut rates, but might not explicitly end up cutting those rates. Yeah, and then going back to this Tom Lee 20% drawdown thesis, we got the midterms coming up. We get a 20% drawdown, and if that's anywhere near, and not get a 40% recovery, as Tom Lee's saying, going into the end of 2026, November, which is when we have midterms, I don't know, if people lose 20% of their retirement accounts, they might not be the happiest going into midterms. So there are some, I think, broader concerns on that entire thesis. But I'm curious about what other analysts have to say, right? Like, so this is Fundstrat's perspective. I'm really curious about, like, what does Morgan Stanley say? Mike Wilson has been pretty damn bullish, and I think his take might be a bit different in terms of how it plays out, but still on the same track record of maintaining a bullish view. And again, my perspective is very simple. Fed easing, AI trade intact. You put those two together, you get a bull market. I don't know if it's 10% up, 20% up, 14% up, 11% up, which is still a great return after 3 years of 20%. But I don't see those two collapsing next year, especially with the new Fed chair. Now, they're trying to collapse the AI trade with every single headline every other day. And we had that taste of that today with Oracle and OpenAI. But if those two narratives stay intact, then I think we're going to be all right. Tom's hurting because of ETH. Well, that's another thing, dude. I think that's the other, I said this when BMNR was getting hit pretty bad in November. He got the timing of it dead wrong, regardless of what you want to say about the thesis, which I think the thesis is very real around stablecoins, tokenization. That stuff's only growing and growing and growing. But the timing of it was dead wrong. So then the question becomes, okay, if we're going to have a meltdown, as he's, again, I'm not saying we're getting a 20% drawdown. This is him saying it. There is no way in hell Ethereum holds up in a 20% draw. That's the first thing people will sell. So then you can't logically be saying buy BMNR, buy Ethereum if you're Tom, if you're also simultaneously saying there will be a 20% drawdown or get ready for a 20% drawdown. And it's like, let's say the 20% drawdown is in June instead of January. Or so like for those 6 months, what would be the value of buying ETH if I know it's going to get nuked whenever the drawdown does happen? Which again is his framework for, it's a tough job being an analyst. It's not an easy, that's why you get all the praise if you're right and you get a lot of blame if you're wrong. It is what it is, but he's been doing this for a long time. But if you're going to put out a guide that says we're going to go down 20% and then say buy a very speculative asset, which has some very real underpinnings and foundational elements towards it around stablecoins and tokenization, but at the end of the day is still going to be subject to a massive drawdown because it is in the world of crypto. You can't logically say those two things. Like, they're just not consistent with each other. Or at least it's hard for me to imagine that it's consistent with each other. And so same thing with small caps. So I don't know. If you believe in his outlook, you can't really believe in Ethereum from a price perspective. You might believe in it for the next 10 years. That's a different question, but I think there maybe is a better opportunity. Well, that's a good point, Vester. He didn't get things wrong. If you think he needs prices to be high in order to dilute to buy more Ethereum, wouldn't be able to in a crypto winter. That is a fair point. The problem is, I feel like he's sitting on 4 billion of losses on ETH. So even if let's say, even if in a crypto winter, a DAT wouldn't have worked, you could probably still launch it. And it's not going to be to the point where he could raise like, I don't know, I think he's raised like $15 billion or something like that. He probably would have gotten able to buy 3% of all ETH, but he could have started buying like maybe 0.5% of ETH in a crypto winter and then eventually scaled it out of the crypto winter. But then you have Tom saying, I don't believe in a crypto winter. He's saying, I don't believe in this 4-year cycle. So, which we should listen to that part of the pod as well. But yeah, there's a fair point, which is that you had to go through the pain of raising that money when things were high. It's just to be bag holding it. I don't know if that's the strongest strategy to go from on Ethereum. He frightened people away because he intends to purchase all the ETH himself. Look, here's the other thing. Or just don't launch a DAT. I mean, I said this the day it launched, and I still believe this, even though I'm long this, which is, I'm just thinking from a branding perspective. Whenever you launch something, the risk of it being successful is now on your name. So whether it's a granny shot ETF, whether it's a hedge fund, whatever it is, like you take the risk of having it work, especially if your public persona is that big. Now, you got to risk some things in life to be successful, like you have to go out on a limb and take a risk. I go out on a limb every morning and take a risk with my jokes, which today weren't as successful as this morning, but nonetheless, you got to try. But you also have to measure the risk. Like a crypto digital asset treasury only works in a raging bull market that has global liquidity flowing to these crypto assets. So if that was going to not necessarily be the case, it's not the best risk to take. Unless you're just so bullish that Ethereum is going to play out. But again, Jamie Dimon himself could be like, I'm buying $1 billion worth of ETH. At the end of the day, it is an asset tied to global liquidity, no matter who gets super excited about it.
Bitcoin was up 36% for the year. And now it's currently, I think it's like flat for the year. So it lost a lot of its gains. I'm still very optimistic because crypto still has its best years ahead. But crypto should have had a good year this year, and it was on track to until there was a liquidity crisis on October 10th. That was a bigger wipeout in terms of liquidation than any event in history. The most recent one before this would have been 2022 with FTX. And that wipeout pales in comparison to what happened on October 10th. But in 2022, it took 8 weeks before the smoke cleared, the leverage wipeout was enough in the mirror that crypto prices began to recover. This week is the 8th week since that crisis. And I think crypto prices are beginning to actually recover. That's why I think Bitcoin can double from here by the end of January. Now, many people don't expect it because of the 4-year cycle.
All right, put in chat, end of January, 160 Bitcoin. He said double from here, right? The 180, 90 times 2 is 180. I mean, what do we think? End of January, 180? Is that realistic to anybody?
And that's going to be the big question. If Bitcoin breaks 125 in January, there is no 4-year cycle.
What did happen on October 10th? Like
90% correct. Because, there's going to be 10% you don't know if there was something else.
Just to clarify, is the reason we don't know what's happening because of the anonymity of crypto? We don't know who owns which wallets, and so it's harder to track what's actually happening?
Well, it's that, and plus, when we look at liquidation events, like in the stock market, 90% of what someone will explain is probably correct, but 10%, like 90%, it would be 90% to correct say that the February to April decline was largely due to the Trump tariffs.
Yes.
But the other 10% would be like, well, stocks were already expensive and they were overdue for a correction. So that's what I mean by 90-10.
So give us your 90%. What do you think happened?
On October 10th, there was 2 things that happened. One was a triggering event, which was Trump announced a re-escalation of tariffs with China, like a tripling of proposed tariffs. And because markets were closed, historically, crypto is what reflects reaction to a macro event when you're already after market hours. Like if the S&P was open, crypto probably wouldn't have got punched as hard. But crypto prices fell. Now, crypto prices falling, system can handle that because, crypto is a hyper volatile by nature. So large swings in prices shouldn't really overload the system. And even volume shouldn't overload the system because crypto trades, there's so much automated trading. However, there was an algorithm in place that actually what I call a glitch happened on a specific exchange, okay? Many people use leverage in crypto. I mean, it attracts leverage trading, but people put up collateral so they can do leverage trading. One of the collaterals is stablecoins, okay? And stablecoins are pretty safe collateral because, hey, if it's Tether, it trades at $1, it's pretty safe collateral. And so you can borrow a lot against safe collateral. And if it was USDC, Circle, that's also a really stable coin because it's backed by $1. However, there was a popular stablecoin called USDA. It was an algorithmic stablecoin, okay?
Okay.
And on one particular exchange, because of the shock of Friday, internal prices, like people bid ask of that stablecoin actually got out of whack. Suddenly the price went to 65 cents, even though it's supposed to be essentially worth $1. So, but within one exchange that the quoted price dropped to 65 cents. Well, that meant that all the collateral for every account that used that particular stablecoin to borrow money was now in deficit. Okay, even if it was just one dollar that traded at that price, it was already putting every single piece of collateral at risk, into deficit. So then something called ADL was triggered, automatic deleveraging. And so in one exchange, everybody who would use that stablecoin as collateral basically got wiped, their accounts liquidated. Well, what were those accounts long? They were long altcoins and all these different cryptos that suddenly got dumped onto spot exchanges. So then on all these other exchanges, suddenly some altcoins suddenly went down 99% because there was a lot of selling from ADL, but it triggered a domino effect of all these other exchanges triggering other ADLs because spot prices of all these alts dropped. So that to me was a glitch because it was like an illiquid quote that didn't represent a true VWAP triggered an ADL that triggered a cascade of ADLs.
So again, Tom Lee has explained this argument multiple times, but he continues to believe that it was a glitch that caused the crypto deleveraging, and maybe that glitch will reverse, which is why he thinks it could double by January. Or maybe that glitch might be, a function of the crypto ecosystem, and that's why we've kind of seen the decline of Bitcoin and Ethereum. Folks, I didn't know if he would make it, but he is backstage. Ladies and gentlemen, probably calling in from the car. We got the milkman. Steve, how are you?
What's going on, Amit?
Have you paid attention to the market at all, or have you been just eating meatballs?
Today was a bad day for me.
Okay, I think it has nothing. I'm assuming your day had nothing to do with the market for why you're saying it's bad.
No, lawyers, meetings,
Yeah, so you were busy the whole day.
Yes, I did make 2 buys, and I did see the market was down. And if you'd like me to say the 3 words, I am happy to.
Well, let me pair it with a question. Do you care about OpenAI and delaying a data center with Oracle?
I don't give a fuck. You mean we're going to delay one data center out of all the data centers that are going up? Good. We don't have enough energy as it is.
Yeah, that's a good point. We don't have enough energy. That's fair.
I mean, one data center. They're freaking out about one data center. Like, come on.
Yeah, look, the price action today was really weird, but all of it, outside of Broadcom going down, I think was based on this OpenAI headline, and I agree. It just doesn't seem like the biggest deal in the world.
It just goes back to, does this matter for the largest companies in the market? OpenAI holding off on one data center is not impacting what Oracle is spending. It is not impacting what Microsoft is spending or any of these other companies. This is not a blemish on AI. AI is very real. And how many data centers that are going to be built is a moving target, and it's going to continue to shift for years. So the bears are trying to grab at any little straw they can.
Okay, so let me ask you some questions about what we've been talking about for the past hour. We listened to this new Tom Lee podcast with Scott Galloway, and it sounded pretty bearish for next year. It's hard to act like he didn't. And this is his thesis, and I just want to know if you think this makes sense. He thinks we're going to go down 20%. So let's say we go from 690 to 550, and then we're going to go up 40% to end the year at 770 on the S&P. He thinks that's how the year plays out. I know you're still thinking through how you think it's going to play out, but is that reasonable to you?
Sure, it's reasonable because a drawback is inevitable. The problem is, to get a 20% drawdown, something dramatic has to happen. I think a drawdown is going to be more in the range of 5 to 10%, unless there's some unforeseen event that happens to make it even more drastic. You look at the Fed data, you look at all the earnings data, it doesn't seem like there's an event that's going to cause a 20% drawdown.
Yes, and I think what's more unrealistic about this is that, correct me if I'm wrong, you've been around markets longer than me, but last time we had a 30% drawdown and then essentially, 50% reversal was this year, and it happened because of Liberation Day and then Trump tweeting buy the dip. For that to happen again, for that 20% and then V-shaped 40%, most hated V-shaped rally, I don't know if that could just happen again randomly, as you said.
It's
There
going
has
to
to
be
be a catalyst.
difficult to it's going to be difficult to happen. One of the problems is too many people have trigger fingers. And for some reason, people just try front running any little piece of news because they think they can outsmart the markets. And in the long run, nobody can outsmart the markets. I mean, it's the hardest thing to do. That's why most traders lose money. And sometimes access to information and access just to move money within a millisecond is not necessarily a great thing because of stuff like that. Now, can we go down 20%? Sure. But I mean, I think it's going to be pretty hard to create a scenario where that happens if we take what the Fed said at face value. You have unemployment that's going to decline. You have GDP growth, which is going to expand. And if we look at earnings data, it's not just the Mag 7. The broad market companies are expanding earnings. I mean, look at Costco.
But that's what made Tom's comments to me very confusing because, as you said, earnings are expanding and the Fed is easing, which means 20% drawdown. We're talking about 5,500 for that to happen. It's hard in that macro landscape. So then what's the reason, right? And as you're listening to the podcast, his argument is 90% of AI stocks are overvalued. This is verbatim what he says. He said, I'm being generous here, probably 95% of them. And then number two, he's like, we need to consolidate a 3-year bull market of gains, which means we inevitably have to have a 20% hit. And it's confusing because if the Fed is easing and the AI trade is still intact, which is defined as earnings are growing, what is the catalyst to just randomly have a 20% drop?
So can I put on my tinfoil hat?
Go ahead.
Tinfoil hat Steve is going to say 20% drawdown is not happening next year because what's the biggest event next year that's going to take place?
Midterms.
And do you really think Trump is going to risk? He did the Liberation Day shit this year because there was no midterms in sight. And he knew that he had time to fix it. Okay? Do you really think that they're going to be reckless next year and risk losing both branches?
Unless Trump ends up just saying he doesn't care anymore. And he's like, you know what, screw it. Like, it is what it is. But if he cares about...
Which I don't think he's going to do because at this point, it's more for legacy than anything else. He can't run again.
Yeah, because if he loses the House and the Senate, he's a lame duck president. He's going to have
screwed.
2 years of nothing. Nothing will get passed. Absolutely nothing. It's over. So, I mean, and so then the question becomes, okay, like if the stock market is sacrificed with some 20% drawdown, can they still win? And I don't think so, because the only way you can imagine they could still win is if affordability becomes phenomenal, right? Like if gas prices just go, like everything gets so much better from the affordability perspective. The problem is if asset prices go down 20%, affordability is going to get worse because the rich are going to stop spending at that point. They're going to feel less rich, right?
And you have more and more people retiring. More and more people are tied to 401k plans rather than pensions. And when you have people in an election year seeing their nest egg declining, that is the most powerful motivator to get out and vote.
Yes. I mean, if you're 65 and you see a 20% drawdown in your nest egg next year, that's not fun.
No. And that could cause people to go out and vote. I don't think they're going to be reckless next year. And I think the combination of a new Fed chair, easing policy, if we don't get an invasion, if we actually get a settlement to the Ukraine war, I mean, I'm not seeing an event that's going to take us down 20%. Are there going to be pockets of 5% declines? Yeah, it happens every year. But 20% decline, that's a huge decline.
That's a massive. That's huge. 29. That was 2022 was a 19.7% decline. So he's expecting us to go through that within 12 months and then rebound 40%. Like, I am so confused. And here's my question to you. Why do you think that's his take?
I have no idea.
Conspiracy theory on where he's getting this?
I don't have any conspiracy theory on it. And I think the real conspiracy theory is more tinfoil hat has to project what is best for the administration because they seem to try to do things in the space of what is going to work for them, and having a market going down heading into midterms is a death sentence. So they're going to do everything politically to keep things at bay.
Some theories I'm seeing in the chat, which honestly, I don't think these are crazy theories, is Tom is compensating for his end of year crypto predictions being so wrong that now he's.
It is a great conspiracy theory, because you know what? His 12,000 Ethereum or whatever it is not looking pretty fucking good right now.
Neither is 250,000 Bitcoin. I mean, like,
Right.
And look, I love Tom, but this is where, as a content creator, I consider myself to be pretty damn objective. I know people think I'm super uber bullish Palantir. They weren't there for 2 years when you and me were on Palantir Weekly every week criticizing the company because we weren't seeing what we needed to see. So I'm going to call things like I see them. And saying 200,000 Bitcoin, it's setting yourself up for, and he just on the podcast, he said Bitcoin should still be double by end of January. That would be 180.
Which is insane.
It's also irresponsible. And that's the other issue, because you start to get into the conversation of Kathy, which, I mean, look, her brand isn't really a brand anymore, because in 2021, she was promising 40% CAGR on Roku for the next 5 years. Like when you say that shit, it doesn't work out egregiously. People stop listening. So I don't know. Maybe that's the argument. Maybe he's becoming more bearish to make up for the fact that he was ultra bullish.
Maybe.
I'm curious to hear a lot of the other analysts and see what they have to say as well, outside of this, Tom. I do want to hear those that are bullish or bearish, or have a potential bullish bearish perspective together around it'll be bad, but it'll be good at the same time. Like, I don't know. That's how I would want to be hearing what goes on into next year. What'd you say?
Has Dan Ives come out and said anything?
Well, he's been calling for 20% NASDAQ. But see, even Dan, dude, I'm happy you brought this up, because I haven't talked about this. Even Dan Ives' recent interviews, he's like, we have 2 years left of this bull market. And I'm just like, well, I was hearing, next 5 to 10 years. Now he's just like, explicitly, we have 2 years left. I'm like, okay, so even he is consolidating the view to like, and I think, I don't blame them. I just think they're realizing, dude, these valuations are getting up there. Yes, you have stocks that are cheap like Meta and Nvidia, but you also have other names that are expensive. And it's hard for them to say it's 10 p.m. at the party, even though they say that, when it might not be 10 p.m. at the party.
Yeah, but look, it can be 10 p.m. at the party, or even 7 p.m. at the party, and valuations can be out of whack on some companies. Being 7 p.m. or 10 p.m. on the party means that these companies have a lot of runway for growth. That has nothing to do with valuations. And look, there are companies that are overvalued. If you think about what a stock actually represents, it represents all the revenue and all the earnings and all the free cash flow that a company is going to produce. And when you're buying one stock over another, you're buying their profitability and their future growth. And there are some things that are overvalued, but that's every market. Now, what is in our favor is the companies that are overvalued are not an overwhelming percentage of the S&P, whereas the largest companies of the S&P look like they're undervalued. So even if some of these companies take a haircut, it's not going to be that detrimental unless people get scared and just start selling across the board. But in all seriousness, if Palantir was to retrace to 125, that shouldn't have a significant relevance on the S&P unless people get shook and start selling off Nvidia, Alphabet, and Amazon.
But the nuance here is that Palantir tends to trade with Nvidia. So I agree with you. Palantir to 125, the multiple would still be very aggressive. But if that were to happen, is it almost inevitable that Nvidia, AMD, all those, like, they have to fall with it? Like, is it even possible for it to independently fall, given how tied up it is in that bucket? I don't know.
It's possible, but the problem is you're going to have too many people trying to jump on the bandwagon. And this is what I don't understand. Why does everybody want to bet against success and bet against progress and bet against American ingenuity? It doesn't make sense why people want to cheer for this stuff not to work. That never made sense to me.
Yeah, look, I agree. And again, to your point about what do you bet on? like Trump just said he wants rates at 1%. Maybe we don't get rates at 1%, but they're going down. Like, where are you going to put your money?
Rates are going to be 2.5%. They're not going to be 1. They'll be 2.5. And that's a great thing. Where do you put your money? You're not generating income on the sidelines in a bond with a 2.5% coupon. What are you going to do? You're going to go buy a $1,000 bond and generate $25?
Yeah, it's again, if you have a lot of money, maybe that sounds like a great idea for no risk, but
different story if you have $100 million.
No.
But for people that are investing and saving for their retirement, saving for a house, or just investing for their future, you're not buying bonds. There's nowhere else to put money but the stock market or real estate. And I don't think many people actually play in the real estate game.
Yes, I don't think many people play the real estate game. I don't think many people are experts on gold and silver and copper. So like the next best thing is the company you use every day, Amazon, or the company that you know is in the headlines every day because they're at the center of AI, which is Nvidia. So, and those companies aren't trading at crazy levels, which is again why I'm perplexed by this. We have to have a 20% drawdown. Definitely we should have some drawdowns. Not saying we shouldn't. 20%, we're talking about erasing the entirety of the year. Unless he's saying we're going to go to 7,300, then we get a 20% drawdown, which, like, again, it just complicates how that plays out. But if we take away this entire year, the earnings multiples are going to get even. Like, I mean, 20% down on Meta, we're talking about what, like a 12 PE at that point.
And here's where what we're not discussing. Between now and the end of next year, you have 4 earnings calls. You have 4 earnings cycles. You're telling me that the sentiment is going to be devastating over the next 4 earnings calls and press releases and prints? I'm not buying that story.
Yeah. I agree. Look, the simple way to protect against all of this, if people do buy into the thesis that we're going to have some massive 20% drawdown or something, it's 2 very simple things to do. Like, it's really not that complicated. And it's about how people, sleep well at night. Take some profits. Number 1, very simple to do. Number 2, you buy some puts. Like, it doesn't have to be super. You don't have to be net bearish on the markets to take some profits or to buy some protection. But the broader question is for straight up bears that are like, nope, short it. It's all going down. I don't know if we can easily justify that when the AI trade and the earnings are very real and the Fed is easing.
But let me ask you something. Hedge funds are professional money managers, correct?
Yeah.
They didn't even get it right on Liberation Day. They were shook selling everything. They didn't get back in at the right time. So what are the chances that individual investors are going to say, you know what, they're calling for a 20% drawdown. I'm going to front run it and sell now, and I'll get back in when the coast is clear.
The chances are 0. But my point is,
Right.
if you need money to pay for your kid who's going to college next year, and
that's a different story.
That's my point. If you simply can't sleep at night because you think things are iffy, then that's how you hedge. You take some profits, right?
Right. But
I agree.
Professional money managers can't even get in and get out at the opportune times. What makes anybody think that they're going to be able to do it also? I mean, it's not easy.
Someone said that kid better get a job.
Like, it just doesn't. The whole thing doesn't make sense to me. And some parts of the market can get expensive, but maybe this is what we need. Maybe we need a reset on people chasing and companies going to the moon, and look at companies such as an ExxonMobil or Chevron being like, we need energy. Energy's not going away. Paying under 10 times EBITDA for this company seems pretty freaking cheap. And
that's another thing I was going to say. The other way to manage it is deleverage out of super high beta names and get into stuff that's in the right thematic, like energy, but that's also relatively inexpensive, like Exxon, as you're saying. But that's another way.
Yes. And the other thing about super beta names is they're super beta. They don't have profitability. And if they do, it's not much. And then you have companies that are pumping out tremendous profitability that are trading at discounts. So maybe we're going to get a little bit of a reset, but that doesn't mean the market has to fall to happen. That could just be a rotation.
Correct. Which, by the way, S&P is not that far from all-time highs, even though Nvidia, Broadcom, et cetera, are down. So we have seen a rotation happen in front of us. It's just a rotation out of tech, which is, annoying for a lot of tech investors. But nonetheless, we are already starting to see that. So that is a very fair point. All right.
Are you worried?
No, I just, this podcast completely, like, I got off the market open and I turned it on. I'm getting some work done and I'm listening to it and I'm not even looking at the screen. And I look at the screen and I'm like, bro, did I just see, like, when you listen to it this weekend, you're going to feel, because the entire chat felt the same when I played it for them. It is not the same Tom Lee. Let's just say that.
Maybe he's catching like last shit, just like you said about crypto. That would make sense. I
think he's under a lot of pressure. Got the crypto call wrong this year. And I think now he's getting, dude, like, remember you and I we were on the phone 2 weeks ago when we listened to Oswath and, he said, sell everything, maybe buy Pokemon cards because everything's horrible. You need to just get out of the market. So Scott Galloway gave Tom the same questions, essentially, the same lead-ins of like, hey, we asked him this, what do you think about it? And then Tom's like, well, I pretty much agree. And then he gives a little bit of it pushback, but like the slightest of pushback to hedge his agreement to stay bullish. But as you're listening to it, you're like, dude, you're not bullish. Like, you can come out if you want to be bearish, but be bearish. But like, you can tell the guy's not necessarily excited. And so that's what really, at least, got me thinking today of like, what's going on here. And so I appreciate your perspective here as well, because to have a 20% drawdown and then 40% upside, that requires some type of event, geopolitics, Liberation Day, something crazy.
And can we add one aspect to this? Most people have their net worth locked up in mutual funds and ETFs in their 401ks or retirement plans. Okay. You also have an environment where pensions are not really a thing anymore, and people are putting in every 2 weeks into their retirement accounts. So if you're in a scenario where people are not selling off their retirement accounts and they're still putting in, then how are we in a situation where we're going to get a huge drawdown if those assets aren't getting sold? Because if you take a poll, take a poll in your chat. You probably have thousands of people right now. Take a poll and put this in it. During Liberation Day, did you sell your retirement assets and then buy back in over the summer? There's probably going to be 10% yes, if that.
Did you sell your retirement assets and then buy back in? Yeah, I really doubt a lot of people did. I definitely didn't do that.
I don't know anybody that did.
No, and to your point, like these retirement funds, passive flows, they're going to be coming in regardless of the market's up or down. So
every 2 weeks.
Every 2 weeks. And then so to have that 20% waterfall decline, it's not going to be because people stop buying every 2 weeks. It's going to have to be because of something. And then it'll beg the question, what is that something? Because Tom Lee's argument right now is just consolidation. I'm like, I don't know if that's enough of an argument for a 20% hit. Consolidation. Like consolidation is max 10% to me.
There is another question about how much leverage should be allowed. And there are ETFs that have 3, 4, 5x leverage. There are people that get a lot of leverage in their trading accounts, and they probably shouldn't have access to that type of leverage. So that's also something that is even more exploited now than ever before. So that's another aspect that we have to take into consideration. And while 1 or 2 people or 1 or 2 funds blowing up because of leverage isn't going to tank a market, but if you get a scenario where there's a lot of things going wrong at the same time, it could make it where you have an event where leverage gets blown up.
Well, I'm hoping that after the freaking, 5% down in November caused just massive levels of margin calls and this, that, blah, blah, blah. I am hoping, I'm just hoping that if we were to get 20% down, as Tom Lee said, that would just wipe out a lot of people.
I mean,
Whether
and
they're-
think about. So what's the poll in your chat right now?
89-11.
Okay, so like I said, around 10% probably sold. That's it. That's not a lot. Stop the poll and add a new one. Ask how many people are have a margin account. I bet you it's like 75%.
Okay, the question rather should be, do you use margin?
Do you use margin?
Because what I'm saying is, I just put the question. I'm hoping that event allowed people to realize that they just can't be that over levered. If we were to get a 20, because if you get a 20% drawdown on margin and you're getting liquidated on a 5% margin drawdown on margin, your account's blown up. It's just done. You're out.
Yes.
So, and again, I don't think there's anything intrinsically wrong with using margin. There's a lot of strategic ways to do it, but being levered heavily in a market that really can't have anything go wrong. We're trying to get 26 times earnings on the S&P. You can't have a 5-10% move if you're that over leveraged, because then it gets you wiped out, right? Now, in April, if it's the bottom and you borrow some money to buy something at 5%, that's going to go up 80%. Like, that's a really smart thing to do. But buying stuff on margin when the market's up 20% for the year, that might not work out if we have a correction.
Do you want to know what I'm going to do if we freaking go down 20%?
I'm scared to ask, but what are you going to do?
No, take one guess of what I'm going to buy if we go down 20%.
Another set of meatballs at Patsy's?
Well, they were delicious, but no.
You know, my sister tried those and she loved it.
Yeah, because they're made the real way. A third beef, a third pork, and a third with veal.
Chat says milk and cookies.
I'm going to buy TQQQ if we go down 20%.
I've never heard you say that.
Because if we go down 20%, what the hell are the chances we're going down another 10?
But see, you got to have cash during that. That's the problem, because when everyone gets wiped out on a 20% hit, no one has the money to buy it. But you're right.
Right, but I mean, I may be sitting on some cash.
Well, I would believe you are.
So I'll be buying some TQQQ if that happens, because you know what? I did not do that in April, and I should have. And every downturn, and this is what people need to realize: take a step back, take a breath, look at a long-term chart. No matter how scary it is in the short term, every gap gets filled. Every downturn gets bought. It may not get bought till 5, 10, 15, 20%, but eventually there has never been a single downturn in the history of the market, from the crash of 29, the Black Monday, to the dot-com bubble, to COVID, that did not rebound. So why are we scared of a crash?
No, I agree. I agree so much. Like, worst case scenario, let's assume there is some 20% drop. That you just got to have some cash. You got to not be over levered and have some freaking cash. Because if we, in this market with these multiples, with this earnings growth, see a 20% decline again, barring some like China invasion or crazy Liberation Day 2.0, that is a back the truck up and buy. But you got to have the cash in that moment to make that happen.
How about this? Maybe we shouldn't be buying short-dated one-week options. Maybe we shouldn't be buying freaking spreads that expire in a week. Maybe we shouldn't be gambling. We should be looking long-term. I mean, a lot has to go right with short-dated investments. And then that's how people lose money. Because a little bit here and a little bit there, when you could just put that into the SPY, it's very hard to outperform when you do stuff like that, because so many things have to go right. But if you buy the SPY for a 5-year period, over a 5-year period, you can almost guarantee in any period in history, it's gone right.
I 100% agree. 100% agree.
So
and
I think go ahead.
Go ahead. You got it.
No, I was just gonna say, I think we need to get this whole short-term trader mentality out of everybody's head and make it normal that you can see a drawdown for 5 or 10%, but it's nothing to get worried about if you don't need the money tomorrow. Just because it says a different, look, if you put 100 grand in and it goes down to 70 grand in 3 months, there is a halfway decent chance that in 6 to 12 months from now, you're sitting at 110, 112 grand. Now, Is that swing fun? Absolutely not. But if you didn't need the money and you weren't going to sell anyway, so what? Just don't look at your account every day.
And that goes back to my other point. Like if you are not ready for a 20% drawdown to have the mentality of, I just don't need to look at my account, I'll be okay. Then that means you're over levered, which goes back to my point as well. Just like take some profits. If you're over levered, delever when things are good, not when you're forced to delever, right? Because then you're selling into weakness, and have that cash on the sidelines ready to go. It's not the worst thing. Like again, when things are recovering from their worst, which is what we saw from April basically to August, that's when it was every single week. Like, Nvidia's at 103, 107. All right, Nvidia got to 120. Well, Nvidia probably should be closer to 150, and then we're buying. Now it's like, all right, you can nibble, but it can't be those massive big buys because Nvidia's up 100% from the lows. Robinhood's up 300% from the lows. So you probably can't take that big of a swing, but that also means you can't get that over levered into taking that big of a swing.
Do you mind if I say something unconventional that goes against what every single person who is smart says?
Okay.
How many people do you hear say cash is trash and I'm losing money sitting in cash? How many people do you hear say that on TV or that you talk to?
Decent number of people.
Good amount, right? You don't hear people say cash is my friend, right?
Yeah.
Okay. How about this? Maybe cash is your friend, because while you can sit there and make an argument about earnings power and buying power and what you can buy today versus what you can buy in the future, I'm not talking about sitting on cash to go buy freaking goods. I'm talking about sitting on cash in your account, and if the market goes down and a stock that you want is at a cheaper price, even if you've gotten inflation and your cash can't buy as much at the supermarket as it could 6 months ago or a year from now, you're actually able to buy more shares of the same company. So is your cash really trash from an investing standpoint? Absolutely not. It's a tool to be utilized.
Well, and that's another point to the idea of it's okay to take some profits, because at the end of the day, if you're up massively on a position and you want to have some of that cash, if you don't want to borrow money when things go bad to buy the dip, which not everyone has access to, then you just need cash. And the way to get cash is potentially to sell out of things that you're up a lot on, or that you're okay with trimming 10% of a position and just holding it on the sideline. So I agree. It becomes a position that becomes useful.
And
whenever we do have a drawdown.
It sits in a money market, it collects a little bit of interest, and it's there in the event that something goes down. Look, not everybody can time everything correctly. And I know everybody's a genius. They get in at the ground floor and everything. I know. The reality is I'm a halfway intelligent person, and I started a position in QXO and it went down on me. It started at 1840. It went down to 16 or so, and I bought more in the high 16s. That cash that I used wasn't trash. That allowed me to get more shares than if I had spent that the first time I bought. And now it's over 20. So was that cash trash that I was sitting on?
No. So I guess you would summarize 2026 so far, as we're a couple weeks away from it, as Fed easing bullish, AI trade for earnings bullish, therefore volatility, yes, but overall bullish. And then midterms is the larger overhang that should secure it being bullish.
Well, how about this? We're forgetting one big component. You may have a housing market that gets unlocked also, and more trade jobs, more people working, real estate brokers making more money, homeowners doing more projects, more capital being spent at Lowe's and Home Depot. So we have a whole nother segment of the economy that may actually pick up next year, because rates may get down to a point where people start doing additions on their homes, or putting a new roof on, or changing the windows and doing projects around the house that they held off on because they didn't want to tap a HELOC or something.
Yeah. I mean, the housing market opening up would be really exciting. Now, we need these freaking rates to come down, which yields are not coming down even after the rate cuts. But if they do, then yes, it does open up the housing market dramatically.
And think about it like this. Q4, we're going to have positive GDP. There is no indication that we're going to have negative GDP in Q4. And if the Fed is calling for positive GDP next year, then the likelihood of having 3 out of 4 quarters in the black is pretty strong. And you need 2 negative quarters to have a technical recession. So if we get 3 quarters next year that are in the black, that means a recession is not happening. So I don't think a recession is as likely as it once was, especially if unemployment starts to soften. You combine that with the lower rate environment, you combine that with a housing market that opens up, and you combine that with expanded earnings, especially in the broad market, it's going to be pretty hard for the market to be flat or go down next year.
No, I agree. I really do. And that's why it's a little confusing, the argument for a massive, massive drawdown without an explanation for how it would happen. Then again, maybe something happens and it is what it is, but and no one can fully predict it. It just it feels like the thematics around housing, midterms, Fed easing, general market participation growing, rates coming down, and then the AI trade being intact.
I don't want to pick on a certain company, so I'm going to use a different one. Maybe we have to normalize companies not getting head over heels on their skis. Maybe companies like Aqua and SMR have no business going to where they went to. Maybe CoreWeave has no business going to 180 before it's actually proven that they can put up profitability. And maybe we need to stop normalizing those things, because that just allows the bears to call things out and try to create a perception based off of things that just become memes, for lack of a better word, because CoreWeave and Nebius and those companies going up to crazy levels, and Aqua and SMR, they have nothing to do with the largest companies that control 50% of the S&P. I mean, what, the top 30 companies is like 50% of the S&P? So a lot of them trade at good valuations.
I'm happy you didn't say Rocket Lab.
No, I'm trying not to pick on certain companies. I'm trying. But no, I mean, it's serious, because it just gives the bears something to point out, saying, well, we must be in a bubble because these companies don't even make money. And look at the valuation they're getting. Or these companies do just a couple of billion in revenue, or not even $1 billion in revenue, and look at the valuation. And they try to highlight that because they know they can't say anything about the companies that have $100 billion in cash on hand, generating over $100 billion in free cash flow or operating income. So,
no, I mean, look, there was a day in October where I went on a really big rant about Oklo. It was at 140, down from like 180, 190 that day. I think it was down for like 20% for the week. And I was like, this thing doesn't deserve to be here. And it's healthy if this thing continues to go down, because this is perfect evidence for bears to be like, look at this clown market. Oklo's at 140. And you can't actually get mad at them for saying that. So the more the nonsense gets flushed out, which, you know, to an extent, S&P is back at close to all-time highs. Oklo's at 87 from 198. So we've seen, it's not saying Oklo's a bad company. It's just say there's no revenue. There's not even the potential of any revenue. There's no deals there's nothing there.
And it just goes to show you that those companies don't mean a single thing for the S&P. If they did, it wouldn't be at all-time highs.
Yeah.
Doesn't have anything to do with market sentiment or anything.
And the thing is, those companies have narratives, right? Because Oklo's in the energy space, nuclear, big deal, data centers. What if they get a $5 billion contract tomorrow by the DOE? Like, that changes everything. So that narrative's keeping them afloat. But then we have to ask ourselves as investors, do we really think it's healthy for a narrative to keep a stock afloat at the level that it's afloat? AKA no earnings, no revenue, but this narrative's enough to make it worth $10 billion. Some stocks get away with that, but not every stock can. And we had a lot of stocks in October, November that were getting away with it, and they ended up getting hit.
Well, I'll tell you, I called one of my buddies today, and he was like, I'm getting absolutely killed in the market. I'm like, what are you talking about? You're getting killed in the market. And he told me how much he was down today. I'm like, Jesus Christ, you need to stop gambling on this bullshit.
How much was he down?
I don't want to say.
We don't know who this friend is. It could be some imaginary character. It doesn't matter.
Let's just say
we have no idea who this
no.
is.
I really don't want to say, because people may be able to figure it out. Let's just say that somebody was down quite a bit on companies that are just straight flyers because they've been doing very well on flyers. And I've been trying to talk them out of doing this degenerate stuff.
And these are options or?
No, straight equity.
Hmm.
But it's highly volatile markets, stuff that's going for FDA phase 3 approvals, that type of stuff.
Hmm.
But once again, it's all speculative stuff. I mean, and it just goes back. If you were in Apple, if you were buying Apple at 170, not listening to people, and it's at 280 and it goes to 260, do you really care?
You don't. You could not give a shit.
No, you don't.
And if you do give a shit, you have some issues in life. Like your stock falls $20 and you bought it $80 ago. You can't be that concerned, right?
Yeah, I think the biggest thing is everybody needs to take a step back and really get a mentality of, okay, I'm still up. Where else would I have made this profit? And maybe I don't have as much money as I did yesterday, but it's still on paper. You still own the asset. It can still go up next week, and the sky is not falling. It has no bearing on what you do tonight or what you do over the weekend.
Agreed. I agree. Oh, thank you for the super chat. What if private equity or commercial real estate crash? That would cause a large downward swing. Yes, I have not done a ton of research, definitely into commercial real estate. I've done a little bit more into private equity. I mean, maybe, I don't know if we're actually in a private equity bubble, but.
Interesting enough, did you listen to All In this week?
I did not.
You need to listen to All In because they have a very big conversation around private equity because of the new taxation rules that are up on the ballot in California. And it is very interesting what they start saying.
So are they bearish private equity or?
I wouldn't say bearish, but they're talking about having to. It's a legit wealth tax. I think the numbers, the people in the chat will be able to tell you. I think it was they would have to pay a 5% unrealized gain or a 10% unrealized gain on private equity that is illiquid, that they can't even sell. And if they have to sell it, it'll be at a deep discount. And basically they said this is going to de-incentivize people to invest, de-incentivize people to work, and people who have money, instead of building new companies or taking chances, they basically be like, I'm rich, I'm just going to retire and do nothing.
Okay, so I don't know if private equity is a bubble or not, but can we all agree, why the hell would anyone want to be in private? Like any retail investor, if your bank says, hey, John, we have this private equity offering for your 401k. Like in what world do you think that's an exciting opportunity? Like a startup is different that potentially, could be a 10-bagger one day. But like some random business that has some good EBITDA margins, it's like Meta's trading at 18 times. Why wouldn't you just, I've never found the fascination around private equity at all. And I feel like it's being pitched as exit liquidity, quite frankly.
That's a great way of putting it. It's being pitched as exit liquidity because it's an off-ramp for people who work there to sell their shares that there's no market for.
And I think what it also is psychologically is people feel cool that they're invested in something private. When in reality, if you keep up with the markets, if you spend even an hour a day on it, you know enough to say, look, Meta is a discount. It's a deal. I don't need to get in touch with my friend who knows a guy to get me into some private thing that doesn't have some exponential AI startup potential, but is just like some random cool thing that you can have in your 401k.
And here's the problem. You'll never see a financial statement. You'll never actually know what they're doing. And it's just much harder to track.
Yeah, I mean, I've not found the fascination with private equity, but I do understand the concern. And yes, that is something we're going to have to keep an eye on. We're going to have to next year.
Yeah, and I mean, the only way that commercial real estate has a very big downturn is if people start turning over the keys because they can't make the unit of economics work for running the building. But as we've seen, when you look at it, go read SL Green's Q3 transcript. They're at 92% occupancy, and they're expecting to get to over 93% by the end of Q4. So that's a really high level. And everybody was worried about New York City real estate. So,
well, the commercial real estate concerns in 2023 ended up never materializing, right? So maybe they have. I don't know if they're going to
And how about this? The narrative around it, well, rates are so high, interest is going up. They're gonna have to refi at higher rates. It's going to destroy their margins, blah, 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 blah. Well, yeah, that didn't happen. And now you're getting a low rate environment. And if rates go to 2.5, there's really no fear on debt at this point, unless companies take less space. But that's not the trends we're seeing. I mean, you look at Realty Income, they still have over a 90% occupancy rate.
Yeah. You want to see something cool?
You can tell me because I can't look at my phone because I'm driving.
Okay, well, I'll share this. I didn't know they were going to do this, guys, but we got the Nvidia account to post my interview.
Wait, what?
We got the Nvidia X account to post the interview. Join Amit as he sits down with Justin, VP of Enterprise at Nvidia.
Oh, that's amazing. Congrats.
Dude, they didn't tell me they were going to do that. I didn't even send them the footage. They must have downloaded it from my YouTube channel and clipped it themselves.
Jensen's next.
And we can get Jensen. Oh my gosh. Imagine we get Jensen on day. Imagine we get Jensen on a day the stock's down 10%. I got to get them to let me do a live stream, not some pre-recorded podcast shit. I want to do a live stream. We're going to be looking at this and like, Jensen, you just lost 400 billion in market cap. Like, okay, well, what's going on? Like, could you imagine?
I mean, that would be great. Congrats. That's awesome that Nvidia did that.
Yeah, I didn't expect them to do that, but that's pretty cool. For those that haven't seen the interview, I'll link it in the chat. But again, that interview, and again, I talked about it on Monday. I talked to one of Nvidia's direct reports, or Jensen's director. He has 30 of them, and this guy Justin, who's been there since 2008, he is one of his. He's like every single day he has to talk with Jensen. I mean, the work ethic he described, the level of opportunity, the fact that Jensen barely sleeps because he's going after this vision of changing the world with AI. You listen to that, and then you hear, oh, Oracle delayed a data center with OpenAI, and then NVIDIA's down 10%. It's like two vastly different perspectives when you hear someone who's in the thick of it every day with Jensen versus a headline that says AI is done because of a delayed data center delay.
Well, and think about this. Does one data center delay change all the GPUs that are already sold? Are they going to get unsold?
Yeah, and it's also like, bro, Oracle came out and said, there's no delays to our timelines. So Oracle was kind of implying we were always going to start at a different time. I don't know why you guys thought we were starting earlier than expected, but they said there's no delays. We have discussed with OpenAI since the beginning when we wanted to start. And maybe you guys are figuring it out. It's later than you expected, but we never said it was starting next month.
And how about this? They have 593 billion in RPO. If OpenAI is delayed on their timeline, got news for everybody. That's not 593 billion from OpenAI. There's other people that need freaking data center services from Oracle. That will get filled. There's no reason to worry.
It should get filled. That is correct. It should get filled, which is why, again, the concerns today were just the fact that took down dude, the entire week's gains after the most dovish Powell we've seen in 2 years, gone because of that headline. It goes to show how fragile this market still is on this AI narrative.
Well, I think I just figured out the title for my tweet. I figured out the title for my tweet. AI bears, thank you. Take the market lower so I can buy more.
I love it. I love it. I mean, if they're going to give us NVIDIA at 130, 140, all right, dude.
I mean, do the math on NVIDIA 130. I mean, that gets to be, you're talking about a tobacco company at that point on a forward basis. I mean, seriously.
Tobacco
Philip
company.
Morris may actually be more expensive on a forward basis than NVIDIA if we put it at 130.
Yeah, no, again, no one's complaining about Philip Morris's multiple or Costco's multiple, but they're complaining about NVIDIA's multiple, which is the part that tends to be annoying. Like either Costco's a bubble or NVIDIA needs to come down, and Costco both need to come down, but NVIDIA's already further down from Costco.
Once again, one of them does 120 billion run rate on net income, and the other does 8 billion. And one of the companies does the entire year for the other company in less than 4 weeks for net income. It just doesn't make sense. I mean, I showed you those numbers without putting labels on those companies. Did that make sense last night that Nvidia does Costco's net income in 3.5 weeks, yet Costco is a bigger multiple?
That's a fair point. It's a very
I mean,
fair
at
point.
what point do we call a spade a spade? And I've always had this argument, and everybody thinks I'm crazy for looking at it like this. And I understand this is not the only way to look at things, but $1 equals $1. And 10% growth equals 10% growth. It does not matter if you sell widgets or AI. If you generate $1 million in revenue and you grow by 50%, and you have two separate companies doing the same numbers, at the end of the day, it's the same exact numbers, but they'll have different multiples. Why is that? I mean, I'm not saying there should be one set of standards, but when you look at the standard deviation, this is insane how out of whack we are on a dollar for dollar basis. It does not make any sense.
Have you ever worn a scarf?
Scarf?
Yeah.
The only time I have worn a scarf is when my office was down on 34th and 10th, and the wind was coming so fiercely off, you needed it to cover your face.
I think scarves are my new thing, dude.
Why?
Well, I wore a scarf today during the market open, and outside of people saying I look like I'm from the Taliban, it was
inside.
Yeah, I was toasty.
I mean, look, listen, if you're in a wind tunnel, like where we were with Uncle Jack's, okay, that becomes a wind tunnel off the river right there. And in the middle of the winter, it is excruciating, that wind. It's crazy how strong it gets, okay? So scarf, hat, yeah, no problem. But if you're talking about wear a scarf inside, you've lost your mind.
Bro, I'm freaking warm. Like, if I did this on Saturday, I wouldn't have missed the show on Monday. Like,
do you really think you got sick because you didn't wear a scarf?
Yes, dude. I'm telling you, my throat, it caught something. Like, because I didn't have a fever. I didn't have an infection. It's either that or I was exhausted, and maybe the exhaustion caught up. But
well, we know you weren't exhausted because you sleep more than anybody I know.
That's not true. I do not sleep more than everybody.
Okay, sure.
All right. Well, you're going live today, right? Are you going live before you go live, or?
I'm thinking about it. I mean, what time are you doing your thing or not?
Oh yeah. So 7:30 I'll be live. So for those that are done for the weekend, I'll see you guys Sunday for the market futures. I will be live again tonight at 7:30 with my new manager, and we're going to be announcing a lot of updates for the channel. If anyone wants to come to the New York City meetup, there is a cap on the amount of people at the meetup. We're capping it off at 300. So the first details will be out tonight, and you'll be able to get all those details. Yeah, that'll be from like 7:30 to like 8:30.
All right, so, I may go live from 6:30 to 7:30. Then I'm not going to be live when you're live.
Okay.
In fact, I think I will go live at 6:30 at 7:30 and go on an AI rant so I can flush out some ideas for the X post.
Yeah, I mean, look, you've had two of those big X posts. One of them went really viral, so I think you should do another one.
Yeah, one of them got over 2 million views.
That's true. That is true.
And I feel like now's the time to do it with everything going haywire.
Yeah. Okay, so I'll link your channel. So Steve will be going live in 30 minutes. I'll be going live in an hour and 30 minutes again. And again, that stream is really just going to be introducing her to the channel. She's going to be playing a big role next year and really helping me manage a lot of different stuff going on. And a lot of details on the meetups that will be out as well. And that should be pretty much it. Look, overall, it was a decent week. S&P is less than 1% away from all-time highs, and Broadcom and Oracle, although their calls kind of sucked, had good earnings. So can't be too upset.
Let's end it with this. People are getting crazy at the S&P as a percentage point off of all-time highs. How silly do we sound?
Yeah.
So.
Oh, I agree. It can't be that. If there's a rotation happening, and that's why Nvidia's not at 200, I can live with that. But S&P, if that was down 7-8%, and then Nvidia's stuff, like that's where okay, there's a market problem. There's not a market problem here. There's an AI bubble narrative problem, which is fine. But broader market. The fact that Eli Lilly and Goldman Sachs are at all-time highs, that's okay. That's good. That's healthy. So it's not bad to see that type of broader market move. All right, that is it for us, folks. Thank you, everybody, for being here. Hopefully, everyone enjoyed their week. I will see you guys back on Sunday. Steve will be live on, I think, Steve, you do stocks and coffees every Sunday now, right? So Steve will probably be live on Sunday again. And yeah, I'll see everybody tonight in a bit. Steve's YouTube right there in the chat. He'll see you guys in 30 minutes. And that's pretty much it. We'll be back later tonight and then on Sunday. There's YouTube right there. John Cena's last match ever tomorrow. Okay. I thought his last match was like 10 years ago, but he seems to keep coming back. I think of my poem, by the way, guys. I still got to think of my poem. So Steve doesn't know that I've become a poet, but I'll I'll have a poem by Monday, hopefully. Better than the poem I had today. Although the poem I had today, I don't think it didn't end up rhyming at the end, which I guess is the function of the poem. Wait, so that's a haiku then, right? Do haikus rhyme? Am I saying it right? Haiku okay, so I had a poem. It just wasn't it was a haiku. That's all it was. Look, haiku poems do not rhyme. So you can still be a poet and not rhyme. So that's what we had today. So I appreciate everyone who enjoyed the haiku instead of a regular poem. All right, that's it for me. Thank you, everybody. I'll be back at 7:30. We'll have a lot more details on the future of the channel, meetups, all that stuff. And then we'll keep going from there. Thank you, everybody. Appreciate it. If I don't see you, enjoy your weekend. And I'll see you Sunday for the market futures. Bye, everybody. Have a good one.